the difference between the two sides of the Atlantic is massive. So yes, I do agree. There's a good case actually for sort of persistent gap between the two on policy rates. But don't forget, the dominant bond market in the world, it's the US. If there's a downward resistance on long-term rates in the US, it has some contagion effect for Europe as well.
Joe Moak of AXA, thank you so much. Really interesting to hear about just the structural differences and how that's going to play going forward. Coming up next, Seema Shah of Principal Asset Management, as well as Carlos Tavares of Stellantis and Ira Robbins of Valley National Bank, breaking down some of the hottest topics of the moment, whether it has to do with the vehicle transition, as well as, of course, competition with China, and of course, commercial real estate on some of the smaller banks and some of the issues there. Right now, no issues in equities, which are clawing back losses after a hotter-than-expected CPI print, marking gains, particularly with the Russell 2000. Yields just a touch lower, heading into retail sales and jobless claims with an ever-seeming strong U.S. economy. This is Bloomberg Surveillance.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
If you look at the Fed, they've been talking about patience, the need for more time, the need for more data.
We still think the Fed will begin cutting late this spring or in the summer, but again, it's just not going to be a straight line.
We think that the Fed is probably going to be on hold here at least until June.
What we're looking at going forward is higher for longer rates, less rate cuts than the market expects.
There's quite a bit more data to come before you get to that June FOMC meeting.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes until that key report on just how much American consumers like to spend. Good morning. This is Bloomberg Surveillance from New York City for our audience worldwide. Good morning. Jonathan Farrow is off today. I am alongside Anne-Marie Hordern and Manus Cranny, which is a wonderful thing. John will be back next week. I'm Lisa Abramowitz. And I got to say, Manus, I can't get over the resilience of a market that is immune to the potential for some other downside surprise, whether it's economic or whether it's with resurgence in inflation.
I think our guest this morning, Julian Emmanuel, really encapsulated the narrative, which is there was an English politician in the 1800s. His name was Disraeli, and it was foreign policy. And it's about splendid isolation. And that concept of splendid isolation is very, very real when it comes to the American equity market. In other words, no matter what happens outside the borders, there's still the resilience of the consumer, there's still a strength within the American equity market, and that leaves you with this splendid isolation. How long does that endure?
Splendid isolation of an economy that's very strong, but also splendid isolation of equities that continue to rise for good reason. That you've got the returns, you've got the sales gains, you've got the upside surprises.
Closed economy.
It's a well, but it's also share buybacks, and it's also dividends. And when you have cash, you distribute it. And we have seen that again and again. And you have to wonder, is this just irrational exuberance, or is this a wall of cash that's being distributed to shareholders because there might not be as many opportunities to buy in a world where a lot of these transactions are not getting through?
Well, is that part of the, I mean, it's not just buybacks here. Buybacks are a huge component of this whole earnings season globally. We've seen it in Stellantis. We've seen it in a number of other companies that we've talked about through the morning time. And so it is about rewarding shareholders for their tolerance. And the question is, can the margins hold up to continue to deliver on the buybacks and the dividend increases?
Which raises this question of some of the cost efficiencies that we keep hearing about. We do keep hearing about layoffs being announced at firms that otherwise are performing well. And it's just
Cisco,
a matter of
5,000
exactly.
Thousands of jobs, 5% of the workforce was it last night? Yes, it was yesterday afternoon.
So what is this turn? How do you make sense of this? Is this a good world, Anne-Marie, or is this a difficult economy? And this is the reason why it's been such a difficult message to communicate at a time where the markets are flying. Economy is a little different.
It's almost difficult to understand as well when Stellantis comes out and says they're going to have buybacks, $3 billion euros worth of these repurchasing, yet at the same time last fall, Stellantis and all the other auto majors said they could not afford union demands. So when you have moments like this, when a massive company is coming out after they had this huge fight with labor unions, I feel like the White House is going to wake up and look at that report and say, oh, now you have the cash on hand.
We actually are speaking with Stellantis, the CEO, coming up, and I really do want to hear specifically how some of these labor negotiations affected their decisions to cut in certain places, because if labor is more expensive in certain places, then in order to preserve your margins, you have to cut elsewhere. How much, from the people who you speak to, the economists, the people in the administration, Anne-Marie, is there sort of an acceptance that there's sort of a trade-off right now with auto manufacturers that are seeing real pressure and a difficulty keeping their margins while also paying and meeting some of the demands made by labor?
Well, this administration is going to want to be on the side of labor. That's one of their biggest...
Well, he went to the picket lines, didn't he?
He went to the picket lines. It's one of their biggest compelling pitches as well when you look at a swing state like Michigan. Their biggest issue, though, is going to be, of course, I think today, retail sales. How much is the growth of the U.S. economy on the back of the American consumer? Treasury Secretary Janet Yellen said yesterday inflation, yeah, tad bit higher, she had to say, but she said overall it is coming down. But at what point does the higher inflation actually start to impact sales and consumers?
Well, so far, there's a little bit of pushback, particularly on the lower priced items, but maybe not as much on the Hermes and Chanel scarves. Coming up, we're going to be speaking with Seema Shah of Principal Asset Management, talking about that equity rally that, as we were talking about, keeps resuming. Like we mentioned before, Carlos Tavares, Stellantis CEO, will be joining us on the company's warning of a turbulent 2024. And don't miss this, Ira Robbins, Valley National Bank CEO, talking on the commercial real estate risks in the regional bank industry and what he's seeing on his own balance sheet. We begin with our top story, the S&P 500 back over 5,000 as stocks regain some of their losses following this week's hotter than expected inflation print. Seema Shah of Principal Asset Management saying this: Equities will likely see volatility in the first half, followed by a rally in the second half as policy easing arrives. Seema Shah joins us now from an actually sunny London. I am curious, Seema, what we're seeing right now, does that count as volatility?
Well, it was volatility for a day. I think that one of the things with the CPI print is, of course, it was an upside surprise. But what happened yesterday is that there is enough ambiguity about that backdrop to enable a lot of that momentum to continue pushing equities higher. So I think the thing is that we know that there could be an element of seasonality. That's potential. We know that there's, of course, as we heard from Austin Goolsbee yesterday, that there's the consideration of what is the implication for the PCE being the most important indicator for the Fed. And then, of course, there's a part which is, I think companies, corporates are really taking a lot of notice of, which is that if you have a stronger inflation print like we had on Tuesday, a lot of it is related to evidence that you have a strong economy. So there isn't that much concern, I think, building at this stage. And it's also, look, it's very, very early days. We don't want to make any major decisions based on one inflation print. But we do know that, of course, we need to be watching very carefully on those price pressures because, of course, as you were just talking about, there could be some fairly significant implications for margins later this year if you don't see CPI continue to fade.
So what do you do with this, with something that could be volatile, that should be volatile, but that just isn't, when you talk about a rate cutting cycle that should boost stock valuations later on, but shouldn't be now? How do you arrange your equity portfolio at a time where everyone seems to be in the same boat and buying ahead of the dip?
Right, so I think you have to take a longer term perspective. I think trying to trade these numbers is just so tough. And what we're doing is we're taking a 6 to 12 month perspective and we're saying, right, we are expecting a slightly slower economy. We think that that will open the door to rate cuts, probably not as much as maybe the market had been hoping. And historically, if you have that soft landing coupled with Fed cuts, that is typically quite positive for equities. So the way that we're seeing it is we're trying to edge into some of the more cyclical trades that we would expect to do well in the second half of the year. So things like small cap, which of course have had more of a volatile period, those are some opportunities that we're trying to take advantage of now.
Seema, good morning to you. In terms of global allocation, I use the phrase, I think I learned it back when I was at school, splendid isolation. But when it comes to equity allocation, is it still America first for the proportion of allocation? You've got Europe in recession, UK in recession, Japan in recession. I'll come back to Japan in a moment. But the weighting must still be to the uniqueness of the US.
Absolutely. So we have maintained that US overweight, whereas Europe stays at an underweight. We have a number of concerns about Europe for this year. And it's not just on the basic economic side. We do think that investors are maybe potentially quite concerned about how Europe is going to be almost a fallout from the US election discussion narrative that's going on there. And for Japan, it has been a slightly more, I think there's been a bigger conversation about the Japanese trade. So we have had an overweight to Japanese equities through most of last year, but we have had some concerns starting to grow. One of them being that, of course, the economy looks like it's slowing down. The other concern had been, although I think this is fading now a little bit, is that once the Bank of Japan starts to move to a tighter policy, then what will be the implication for yen and therefore on corporate earnings? But I think given valuations now for Japan are actually flagging as quite expensive, you could see a number of people starting to close out that trade and looking for something else. And at this point in time, it's still all about US equities.
Do you sense any semblance of exhaustion? You talk about Japan maybe having run its last mile at the highest level since 1989. You're looking at dollar yen above 150. You look at these equity markets above 5,000. I had a guest this morning on Bloomberg Brief talking about 5,500 as a conservative estimate. From the sentiment and from the people that you talk to and the flow, is there any sense of overly long, overly exhausted, and perhaps it is time to trim?
We are starting to hear those conversations. So a number of clients becoming a little bit more cautious, posing a little bit more deeper, kind of poking more questions about the Japan trade. With that idea that, look, it's been pretty good. It's worked out very well. It was one of the favored ones last year. But can we honestly expect it to continue with the various dynamics that could play through for this year? And particularly when you look across the global economy and you think, well, where is the real economic strength for this year? Where are the geopolitical tensions and which parts of the global market are going to be most impacted? It really does feel like the US continues to come up trumps on this. So there is, I think, a waning interest in a number of the international markets that there were before.
So is there interest in the markets that haven't gotten as loved? I'm thinking of Michael Burry's big bet on Chinese tech companies. Are you following in?
We're not. We continue to be very cautious about China. Look, with China, it has the potential to surprise. We know that policymakers in the past have suddenly introduced very significant policy schemes and policy mechanisms. But at this point in time, going from their narrative about avoiding over-leverage, trying to redirect their economy, concerns about the debt level, we think it's quite unlikely right now that they're going to do anything that would significantly improve investor sentiment towards China. So that's an area that I think we're more concerned about. There are areas of the market within emerging markets, for example, Latin America, where actually you're seeing the fundamentals, valuations, and technicals start to collide in a very, very positive way. So there are opportunities, but it still always kind of leads back to the US.
All roads lead back to the US. We're about to talk to the CEO of Stellantis about a myriad of different things. We've seen some of the Europeans hand back money, the oil majors. I mean, the buybacks here in the United States of America have been phenomenal in that oil sector, in the European sector as well. So buybacks are definitely a hallmark of this reporting season. How sustainable are those, Seema? How much attention do you pay to that?
I think you have to pay attention to it. I mean, buybacks have sometimes in previous cycles where maybe the fundamentals are looking a little bit more concerning, buybacks can just continue to drive the market higher. So we're watching that. I think though for this year, and it's slightly related, is it just does come back to those margins. We have been expecting some kind of margin pressure through the remainder of 2024. And one of the areas of the CPI print that you have to, I think, relate back to that margin pressure is, how many times can companies continue to raise prices? Typically, I think companies can raise it once, they can raise it twice. But on a third time, consumers start to lose interest and they turn away. And at that point, companies really start to face margin problems. Do they start to cut labor? Or as an investor, do you start to really think, okay, which company do we know is going to be able to maintain some of that margin pressure, even as other companies are struggling to raise prices?
Which reminds me of Hermes silk scarves, excuse me. Seema Shah of Principal Asset Management. Thank you so much. Well, it's true. I mean, they raised prices by about 9%.
Do you know what makes me laugh? Is you're thinking about Hermes silk scarves, I'm thinking, yeah, and it was actually Heineken the other day that said, volumes will be down next year because we can't seem to sustain these price rises. Consumers are now beginning to vote with their euro, their pound, their dollar, whatever, not just Hermes.
Well, but they think that the distinction is actually really important. Heineken versus Hermes, it's a very different cohort of where you can get the pricing power.
Can I just say, the Hermes ties don't hold the microphones very well.
We're crying for you. Let's get an update on stories around the world. Here's your brief with Yahaira Chakas. Yahaira.
Hi, Lisa. A celebration ended in chaos in Kansas City. At least one person is dead and more than 20 others wounded in a mass shooting during the Kansas City Chiefs Super Bowl victory parade. Authorities say at least 8 of the victims are children. 3 suspects are now in custody. Mayor Quinton Lucas says the White House and federal agencies have offered assistance while President Biden renewed his call for an assault weapons ban. Shares of Deere are sliding after it cut its profit outlook for the year. The company's saying farmers are buying fewer tractors due to falling crop prices. Deere is seen as a bellwether for the agriculture industry, but the machinery maker has been under pressure due to declining income in that same sector. The company's forecast cut came as a reported first quarter earnings that actually beat estimates after it increased costs for its equipment. For the second time this year, a U.S. company is embarking on a mission to put a spacecraft on the moon. The Nova C moon lander, built by Houston-based Intuitive Machines, took off from the Kennedy Space Center this morning on a SpaceX rocket. It will attempt to land on the moon in about a week, and if successful, it will be the first privately built lander on the lunar surface. The mission comes after failed attempts by companies from Israel and Japan. That's your Bloomberg Brief. Lisa?
Yahaira, thank you so much. Up next, a bumpy road ahead for electric vehicles.
We think 2024 is probably a bit tricky year, but 2025 you will see again the thing picking up because everybody will have to match the targets in 2025.
That's next. You're watching Bloomberg Surveillance.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance. Welcome back on Retail Sales Thursday, as well as jobless claims. We do see a bit of a lift to markets. Ahead of all of those, we see about more than 0.1%, crossing that 5,000 line. Yields just a touch lower. The euro gaining versus the dollar. Crude off as people still see supply as overwhelming demand. Let's get straight to it. One of the key questions has been the auto manufacturers and a bumpy road ahead. So under more surveillance this morning, a bumpy road ahead, not just for all vehicles, but electric vehicles in particular.
We think 2024 is probably a bit tricky year, but 2025 you will see again the thing picking up because everybody will have to match the targets in 2025. So that's my view on the thing. We shouldn't doubt about the fact that EV will be a dominant technology in Europe. Maybe not the only one, okay, but it will be very, very strong, I think.
Here's the latest. Stellantis rising after the company announced a €3 billion buyback. The maker of Jeep vehicles warning of a, quote, pretty turbulent year ahead, facing higher costs, a drop in market share, and softening demand for electric vehicles. Joining us now, I am so pleased to say, is Stellantis CEO Carlos Tavares. Carlos, when you talk about a turbulent year ahead, is it because of a lack of demand? Is it because of competition from China? Is it because of politics? Or is it because, frankly, people are just pushing back against pricing?
Well, I think it's because all of the things you said, but we did not say it was more turbulent than 23. We said it was turbulent, which means, our industry and specifically Stellantis is now used to manage turbulent situations. It's obvious that from an economics, geopolitics, technology, offensive of Chinese competitors, we expect 2024 to be quite turbulent, indeed quite dynamic. But you know also that Stellantis is all about sports. It's all about racing. It is in our DNA to race, which means we like turbulence. We like because it's a very competitive period in which you can demonstrate eventually that you are better than the other guys. So we like turbulence as an opportunity to show competitive edge for the company.
And we can get into that in just a minute. I am curious about some of the increased costs, in particular due to some of the labor negotiations that we've been seeing in the United States. I'm just wondering from your perspective how that's featured into some potential cost cutting or other measures to try to offset some of the higher fees.
Absolutely. You see that what is the most important for us is that we deliver on our mission, which is to offer safe, clean, and affordable mobility. This is our mission. Right now, we know that we have a challenge on affordability. Affordability means that we need to absorb the additional cost of the EV technology. It's around 30 to 40%. So we need to absorb it. And we need to absorb it by a better design to cost, by more efficiency in everything we do, in our plants, in our supply chain, in our logistics. We need to make sure that at the end of the day, when we go to market, we have the most optimized strategy in the way to go to market. All of this is creating a huge area for optimization to accelerate the productivity that will mitigate the additional cost of the technology in order for us to make it very simple to sell BEV cars at the price of ICE cars. This is the mission we have, and we expect to work very hard on that. The good thing is that As we delivered record results in 2023, we at the same time recognized that we did not do everything right. So all the things that operationally we did not do in a perfect way in 23 represent as many opportunities to do it better in 24 and contribute at one point in time to bringing BEV products to the market at the price of the ICEs. That's our mission.
Well, to get to that mission, does this mean more layoffs of people in the U.S. to compensate for some of those wage increases that happened at the end of the year?
What it means is that we are in a transformation. Perhaps it's good that we take a few seconds to explain that a transformation is not an addition, which means as we are expected to transform our industry to a more automotive tech-oriented industry with zero-emission vehicles, what we are going to do is we are going to transform. Transform means less here and more there. Let me give you an example. We have been creating a very significant brand new division of software engineers with more than 4,000 software engineers just to take care of the infotainment, take care of the new electronic architectures, and make sure that we bring all the services in the car that the consumers are expecting from us. So we are creating tons of jobs on software engineering. We may need less in other kinds of technologies, like, for instance, internal combustion engine technologies. So transformation means it's not an addition, means it's a change from what exists today to something different. This is what we are somewhere instructed to do in this very significant transformation of our industry.
So, Carlos, can we discuss the further transformation? The market is tuned in here this morning, and they want to know where you and the chairman are. You're throwing off cash, up the dividend, great for the shareholders this morning. The market expects you to produce $30 billion in net cash this year. What the market will want to know is how aligned are you with John Elkann? You've both been on the tape. You're talking about M&A, he's pushing back. There are no plans being studied regarding mergers of Stellantis with other manufacturers. You're the CEO. We know you're an advocate of M&A. How aligned are you? Are you actively lobbying John to engage in M&A? Are you at odds, or are you together?
I think you just have to read carefully what was said by the company and by our chairman in the sequence. The company said when those speculations, which by the way are pure speculations, when they appeared, we said there is nothing ongoing. There is a statement, a press release from the company at that point in time. 24 hours later, the chairman, John Elkann, confirmed the same way. So I don't know where you are seeing any kind of misalignment. I just see a perfect alignment on those statements. So I want to confirm that indeed there is a perfect alignment. There is no ongoing M&A discussions. There is the perfect recognition that in the future, the companies which are not fit to face the Chinese competition may put themselves in trouble. We are not among those ones because we are one of the most profitable OEMs on the planet. So we expect to stay healthy, because if those opportunities were to come, then we'll be there eventually. But at this stage, I can confirm, as we did in a statement that was confirmed by the chairman a few hours later, that there is no ongoing discussion on that matter. So there is no misalignment, and there is no M&A discussions right now. That was a pure speculation from a certain number of media, and you know perfectly well where it's coming from.
Carlos, just quickly here, I am wondering, though, if you're basically saying that even without M&A, without making any acquisitions, Stellantis can compete on the electric vehicle front with China, given the current structure?
I think we can. I think we can. The only open question will be the speed at which we are going to progress. I think we can. I think we have enough ideas. And we have enough things that we are not doing perfectly well, that we could do better. I think that our supply chain has been changing significantly in terms of more vertical integration that gives us more cost competitiveness in everything we do. So I think that when we look at the pool of ideas that we have to bring the cost of EVs down to the level of ICEs is quite large. And of course, we are embracing that. I would say in a very exciting way, because we want to get the job done very quickly. Then are we going to be able to do it as fast as we wanted to? That's something we'll see in the future. But There is a very important thing you can see already now, is that in the European market, we are bringing the new EC3 Citroën at 23,300 euros, let's say $25,000, with a mid-trim, with a full equipment and features, and that car is perfectly fit to face the Chinese competition. So we are already there, and that car is sold with some profit. Not as much profit as we would like, but it's already there. So we are getting there, and we expect now to accelerate.
Carlos Tavares, unfortunately, we have to leave it there. SLED to CEO, thank you so much. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
An hour until key economic data in the U.S., jobless claims as well as retail sales. Right now, you're not seeing much drama in markets as they continue to claw back gains after that hotter than expected CPI that for a moment created some turbulence, and then it was a dip that everybody bought. Climbing above 5,000, S&P futures 50.25. NASDAQ also gaining. Russell 2000 outperforming up 0.8% as people retrace some of their higher for longer kinds of bets, which you could see in the currency space and in the bond space is similar. In the bond space, 2-year 10-year, 30-year, all yields lower, although marginally so as people look to what we get in about 60 minutes time. 10-year yields 4.22% rounded up to the nearest tenth. And I got to say, this is kind of where we're at this morning. Not a lot of drama. And the euro gaining versus the dollar after quite a bit of weakness, gaining just a touch here at 107.44. Let's get straight to it because we have a fantastic guest coming up. Under surveillance this morning, Republican presidential hopeful Donald Trump considering a NATO makeover if he wins a second term in office, with guarantees only provided for nations that hit defense spending goals. This according to Bloomberg reporting. Trump advisors also discussing getting Ukraine and Russia to negotiate an end to their war. This comes as Russian President Vladimir Putin praised Joe Biden as being better for Russia than Trump. Putin calling Biden a, quote, predictable old-style politician, seemingly trying to pile on to other concerns maybe about his age. What do you make of that, the Putin comments, Anne-Marie?
Well, what I find interesting is that last time I was in a room with Putin, with our editor-in-chief, and we asked about this, it was ahead of 2016 election, and it was Hillary Clinton versus Trump. He did not want to weigh in on it, and he said he's willing to work with anyone. There has been some reporting we've had that people in the Kremlin have found that they didn't understand Trump, so it's too unpredictable, where Biden potentially would be a more predictable path. But also, this is just likely Putin trying to weigh into U.S. politics because that's what he does.
All right. Well, I'm sure we can expect more of that in the election that everyone is incredibly excited to talk about for another 9 months. Meanwhile, fresh data showing the UK slipped into a mild recession in the second half of last year. GDP falling 0.3% in the fourth quarter, marking the second straight quarterly decline. Japan also slipping into recession, at least technically, pushing back bets on when the Bank of Japan will end its negative interest rate policy. GDP falling 0.4% in the final quarter. Economists, get this, had been estimating growth of 1.1%, a pretty big miss, Manis. And you would expect there to be a pretty big sell-off in stocks because that really raises concerns about the health of the economy. And no. Yeah, exactly. Yeah. So just it sort of speaks to this Teflon feeling that we have in markets.
Two things. The rates market did move. The rates market did react. It went from 60 basis points cuts to 79 basis points. We had Gilles Mouek with us just a short time ago, and he said, look, looks like a recession, but it certainly doesn't feel like a recession.
Which is the reason why people are maybe looking...
Well, they've still got jobs.
They've still got jobs. And so this raises this question of what is the monetary impulse and response, which we will get into in a little bit. Meanwhile, the stock that keeps on giving, NVIDIA's market cap surpassing Alphabet's, rising to $1.83 trillion as the chipmaker's AI-fueled rally shows little sign of slowing. The stock up almost 50% this year, making it the best performer on both the S&P 500 and the NASDAQ 100. Basically, the best performer ever, anywhere, all the time. And NVIDIA is now the third largest U.S. company behind Microsoft and Apple, which raises this question. And Manis, you were really interested in this, as was I, rightly so, when Julian was saying that the NVIDIA earnings next week could single-handedly shake the enthusiasm that we've been seeing in markets.
Look, to use a phrase, when you put an order in, it can either fill or kill the emotion of the bid and the offer here. That's it. It's going to fill or kill the AI trade. Temporarily.
Yeah, maybe, exactly. And as long as they beat above, 20% more than people were expecting, everything should be fine. But basically, if they just come in line, that's going to be a massive miss. We want to shift to financials because there have been so many questions around some of the regional banking sector. The regional banks down more than 10% this year amid souring loan loss provisions and weakening credit quality, as well as concerns about an inverted yield curve. The sector under pressure with regulators targeting roughly 24 banks for their portfolios of commercial real estate loans. Among those facing scrutiny, Valley National Bank, the company saying this: we remain comfortable with our diverse and granular commercial real estate portfolio, adding, quote, as always, we value and benefit from regular dialogue with our regulators. We are so glad to say that Valley National Bank CEO Ira Robbins joins us now. Ira, could you just talk about what people have wrong when they talk about the concentration of commercial real estate on regional banks, and this being a really significant concern?
I think everyone tends to look at a commercial real estate loan and assume it's the exact same type of loan, the same type of borrower, same type of structure, et cetera. Reality is every single commercial real estate loan has some different nuances associated with it, whether it's an office loan, whether it's a multifamily loan, whether it's a single-purpose loan for an owner-occupied individual looking to just support what his or her doing for their individual businesses. The geography makes a significant difference as well. The size of the loan makes a big difference. At Valley, our average office is only $6 million in size, which is a very small type of loan. Really, it's just a doctor in an office in New York City. That's it, which is very different from what you see in other portfolios.
Even still, there is a sort of fear that we haven't seen the real repricing in real estate, given the stasis that we've seen in the market. How much have you had to reprice assumptions of your holdings at a time where mortgage rates have skyrocketed and you see a real lack of demand, particularly in urban areas?
I think it's a really great question because there's a bunch of different variables that run into a repricing scenario. One is just sort of where the interest rates are, where cap rates are. The other is behavior, right? So what's happening from a behavior perspective? Are people putting back into the office? Are people changing behaviors as to what size offices that they want? Those are harder things to sort of determine when you're looking at the repricing risk. For Valley, we've had $2.8 billion of loans repriced in the last 12 months or mature. We have not had to restructure one loan at that whole $2.8 billion. Other portfolios across some of our peers have had to restructure those loans based on interest rates, based on behavior changes. So once again, it goes to the uniqueness of each individual organization, how they underwrote, the type of borrowers that they have. But every commercial real estate loan is not the same.
Good morning, good to see you. And again, we sit in this Bloomberg room and we talk about commercial real estate and we talk about the pressure that it can be brought to bear on the real economy. So put it in context. You're lending. What have you brought the credit committee together and said? Have you changed the credit rules? Have you tightened things up? Have you given the credit team a new definitive line, which is tighter, smarter? Let's pull back. What is the message that you've given to the credit committee?
Look, I think credit across the entire space has definitely pulled back, right? And I think that's some of the things we're looking at. I think the stress test that we do, historically, we run 200-300 basis points of stress tests. So today's interest rate environment's 5-6% on wherever rate that we're doing. We're now saying, hey, instead of just testing 200 basis points up, now we're testing 300 basis points up. At Valley, I think we were always concerned about what happened with the actual cap rates, right? We had cap rates get down to 3%, which is crazy. We floored ours at 5%, which I think makes a different type of borrower that we were looking at. So I think we're trying to be more granular in what we're looking at.
Okay. The issue is this, it's about the loan book to capital. Now, my understanding from what I've read, and this is one of the moments when CEOs will possibly correct me on the percentage, you 550%, your commercial real estate book is 550% of your overall capital. Are you comfortable with that? Are you really comfortable with that? Are the regulators comfortable with that? Have they come in and said, this is excessive? Convince the market this morning that's the right number.
I think that the regulators have for us rules that say once you get over 300% in capital, as you're describing, you have additional scrutiny that needs to be performed on that portfolio. We've been with the OCC for many years. They've looked at our portfolio. There's heightened standards associated with it. For us, it's the granularity that sits within that portfolio, right? We only have 421 million of rent regulated in New York City, right? So once again, the type of concentration that you have is very, very different. Almost 200% of that concentration that you're talking about is for owner-occupied. So those are actual borrowers, right? It's their own cash flow that supports that commercial real estate payment. Very, very different than what it is at other organizations. And I think it's important to have a good dialogue with your regulators, have them understand what goes on. So we feel we have a really good dialogue and not much concern.
But are they taking a closer look at you than in the past they otherwise wouldn't?
I think, look, a regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that. But I don't think it's anything out of the ordinary versus what would have happened if there was more concern within another sector.
When you take a look at the way that some Congress members are trying to propose new regulation, you laugh. Why are you laughing?
To me, it's an unbelievable irony as to sort of how we're thinking about regulation across the banking sector today. I mean, if you were to look at a banking sector and say, what do we want for 2024 and how do we think about growth? And we sat there and said, we want to make sure that every consumer business has an opportunity. We want to make sure that there's a diverse banking system across our country to support entrepreneurial and business growth. Is this the regulatory structure that you would create? And the answer would be absolutely no. Right? We have an FDIC that's responsible for regulation. We have an FRB that's responsible for regulation. OCC that's responsible for regulation. CFPB that's responsible for regulation. For credit unions, NCUA that's responsible for regulation. It is a challenging environment, and especially when you're in the banking industry, where an industry is focused on a confidence of trust, right? If there's not trust within an industry, then people are concerned about keeping their deposits at specific banks. And when you have such a bifurcated regulatory environment, one weak link creates that confidence of trust.
Are you saying that if some of the regulation that's currently being proposed goes into effect, that you expect a number of smaller banks to go out of business?
I think we have real challenges with the granularity of what our diverse banking system looks like. You look at Canada and some of these other countries, and are they really better off by only having a few large banks? Business growth in those countries is not as dynamic as what it is in the United States. Development of entrepreneurs is not as dynamic as what it is in the United States. The ability to get a loan in our country where you don't have to fit into a box is done by banks like Valley, is done by banks that are smaller than us. And when we don't equal a level playing field across our industry based on the dichotomy of what's going on with regulation, it's bad for the U.S. economy, it's bad for jobs, and it's bad for the future of our country.
Well, I mean, that's a lot on regulation. The one thing that we debate again in this room and in this house is about where the Fed goes, and that has got a direct consequence. I'm curious to know whether there's like a pent-up level of demand out there for these rate cuts to come through. We see lots of memes on Instagram. There's this horde of people waiting to borrow when these rate cuts come. Talk us through your thesis in terms of the strength of the business without rate cuts and what could come if we get 3-4 rate cuts this year.
I think just look at the slope of the curve, right? We are in an inverted curve. I like to sit there and say that it's the
longest in history almost.
But it's a full moon, right? You have crazy actions that happen when you're in full moons, and that's what's happening in the inverted curve. Banks' business models were not made to make money in an inverted curve. And it's the longest, as you said, for how long now?
In history.
Right, so I think any type of normalization of a slope of a yield curve is going to be positive for the banks, whether that's long end coming down or whether that's the long end going up or short end coming down. I think the banking environment in the country will do better when there's a normal sloping yield curve term structure of interest rates.
The problem is that a lot of the things that we're talking about right now, you don't have a lot of control over. You don't have a lot of control over the shape of the yield curve. You don't have a lot of control over appetite for real estate in certain areas. So how do you try to survive and thrive and make money in an environment that's stacked against you?
I think it just goes back to what creates franchise value within an organization. I used to run the asset liability management at our organization, and I always said, I'm not creating franchise value for our shareholders by taking a bet on short-term or long-term interest rates. Franchise value is a function of the new clients that you bring in and the relationships that you have. So that's what our focus is. We try to be as neutral as possible when it comes to managing the interest rate position, but once again, it's hard when you're in an environment that's an inverted curve. So for us at Valley, we grew 4.5% consumer households this last year, 10.6% commercial households this last year. So though it's a challenging interest rate environment, without question, franchise value growth is definitely happening.
And we're going to go just to that point in the upcoming segment. We want to talk about commercial real estate, or not just commercial real estate, but also commercial lending and retail lending at a time where the U.S. consumer seems to be very strong. Ira Robbins of Valley National Bank is going to be sticking with us. Right now, let's get an update on stories elsewhere in the world. Here's your Bloomberg brief with Yahira Hakis. Yahira.
Hi, Lisa. Job cuts on the way at Morgan Stanley. The bank plans to slash several hundred jobs in its wealth management business. That would affect less than 1% of employees in the group of about 40,000 workers. The cuts will be the first under new CEO Ted Pick, who took the helm in January. Morgan Stanley cut more than 3,000 jobs last year as the bank looked to reduce expenses amid a drought in deal making. Colorado is the second state standing in the way of Kroger's $25 billion acquisition of Albertsons. State Attorney General Phil Weiser is seeking a preliminary injunction that would prevent the deal from closing. He says the merger would leave Colorado communities with less access to groceries. The move comes just a month after Washington filed a lawsuit over the deal. The FTC has been reviewing the proposed takeover for over a year. And Airbus is planning to deliver about 800 aircrafts this year. That's slightly lower than analysts expected. The plane maker striking a cautious tone as supply chain issues persist. While investors had hoped for a more ambitious output, the target will see Airbus pull further ahead of rival Boeing, which was forced to cap its delivery plans after an accident that saw a fuselage panel blow out during a flight. That's your Bloomberg Brief. Lisa?
Yahira, thank you so much. Up next, AI driving NVIDIA higher.
The AI revolution's playing out. This is the biggest tech trend since 1995. Who's leading it? It's the godfather of AI, Jensen and NVIDIA, along with Nadella and Redmond. And now this tidal wave is coming
Up next, we're going to talk about Dan Ives and his incredible wardrobe, which he wants to give fashion advice to Jonathan Vera when he returns. That is next. No, that's not what's next. You're watching Bloomberg Surveillance.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Day of U.S. economic data as we try to figure out whether we have to care once again about a CPI print that came in hotter than expected. Right now, nobody's caring too much. You're seeing a bit of a bid into stocks as well as bonds. It's the everything rally sort of tepidly. Not a lot of drama here. A bit of a dollar weakness. Euro strength 107.46. Crude off just a touch as we do get information that maybe supplies really are going to continue to outweigh demand, down about 0.6%. Under surveillance this morning. Guess what? AI is driving NVIDIA higher.
The AI revolution's playing out. This is the biggest tech trend since 1995. Who's leading it? It's the godfather of AI, Jensen and NVIDIA, along with Nadella and Redmond. And now this tidal wave is coming. We expect next week, whatever the knee-jerk reaction is, this is going to be just another massive quarter that shows monetization of AI. It's here.
And I think a lot of people are banking on that. The latest is NVIDIA's market cap reaching $1.83 trillion, passing Alphabet to become America's third biggest company. No one heard about it a couple of years ago. The stock up over 49% this year ahead of its earnings, due out next Wednesday. Drum roll, please. Joining us now, Mandeep Singh, senior technology analyst at Bloomberg Intelligence. Could this shatter the market rally and perception, or as Dan Ives said, is it going to be just another blockbuster that we can chalk up in the books as another way up to double their value?
I mean, in terms of their quarter, I think they're probably going to deliver a good beat and raise as they have done in the last few quarters. The question still remains, right now the market is treating everything as an AI tailwind. And, you know, there are a lot of incumbent companies like Intel. We saw with Cisco last night, they missed. They're going to get cannibalized in terms of their existing chips that they sell. And that is what is not being priced in perfectly right now, given, you know, everyone is bullish on AI. They can see the incremental revenue in Microsoft and NVIDIA, but overall IT spending doesn't grow 30-40%. Yes, AI spending will, but it's going to come at the expense of existing IT revenue, and that's what I think the market still needs to figure out.
But then is this where the margin comes in for NVIDIA, which is in terms of what they deliver relative to their peers? It's you choose their product because of the, let's say, productivity uplift that you get with their product relative to other people?
I mean, right now the market still seems so supply constrained you look at, at the company level, what the hyperscalers are doing in terms of CapEx, what the governments are doing. Now the governments are looking to build their own LLMs because they want proprietary,
That's about security, isn't it?
Exactly, and so there is insatiable demand, and right now I would argue NVIDIA is probably over-earning when you look at, the long term, what they're gonna earn 10 years, 20 years down the line. The normalized level of earnings would probably be lower than this, but they are setting the bar so high, and they keep beating that, and it's gonna continue probably for a couple of quarters.
What is it that could cause NVIDIA to not fall, but to trip? What is the road ahead for them? Is it capacity? Is it constraint? What is the constraint that NVIDIA may well face?
That hyperscalers are developing their own chips, and they want to use their own vertical integration. Think of what Apple has done with smartphones.
Right.
They use their own chips for the devices, right? And that's what they're going to do at the device level. At the data center server level, which is where we are seeing a massive refresh cycle, that's where these companies, the hyperscalers, Amazon, Google, and Microsoft, they ideally would want to use their own chips for training their large language models. The governments will still buy from NVIDIA, and NVIDIA still has that software layer which kind of gives them the ubiquity in terms of, being used anywhere in any data center. But I would argue, given the pricing lift we have seen for NVIDIA chips, these companies don't want to spend, 10% of their CapEx every year on just buying from NVIDIA.
Mandeep Singh, thank you so much, as always, of Bloomberg Intelligence. We will, I'm sure, be catching up with you, if not tomorrow, then the day after, as we really chart this trajectory upward and beyond. Ira Robbins of Valley National Bank still with us, which I'm so pleased to say. Before we get into some of the lending picture, et cetera, I want to just ask about AI and how it's transforming your business model, if you're adapting any kind of significant tech changes, or if it's still sort of theoretical at this point.
We definitely have a group within the organization that's focused on AI. I think technology and process improvement is something we focused on. When I took over as CEO, we were 3,325 employees, $21 billion. Today, we're $62 billion and under 3,700 employees, right? So being able to take technology and embed it within an organization is really critical to the future growth and the franchise value. That said, I think AI still needs to be played out. I think there's a lot of concern from the regulatory perspective about what that does from a fair lending perspective, how you're making decisions across the organization. So I think it's a bit more hype at this point until you see the actual input that's going to sit there and begin to be used within each organization.
Interesting about the fair lending and some of the inputs and the models and how you examine that. I am curious, when you talk about lending, you have increased your consumer book quite a bit. Are you seeing the same resilience and strength that we keep talking about in some of this data in the underlying performance, delinquencies, and defaults underlying those loans?
We have a lot of residential mortgage loans on our books. We have a lot of consumer loans, largely through the auto book that we have. Delinquencies have upticked just slightly. I think the consumer is a little bit more stressed than what they were before. But as long as employment's strong, I think there's a resiliency that sits within all of the consumers. So while we've seen a little bit of an uptick, they were really on anemic numbers to begin with. So I think we're in pretty good shape.
But what do you say when you see Americans now owe more than $1 trillion? This is the latest data we have on their credit cards. I mean, how concerning is that for delinquencies?
It's scary. I think we were talking about auto loans before you had someone on that was describing sort of what's happened within their own individual income, right? So the auto industry has really changed. When you go and buy a car today, typically it was a 5-year, 6-year loan. Now we stretch that out to 7, 8, 9, 10-ish years in some cases. Consumers are focused on a payment. $700 is the average payment today for an auto loan. That's a lot of money, right? And I think credit across the entire country, whether it be through autos, whether it be through credit cards, are extending and creating the ability for the consumer to continue to live in debt. At some point, there's a day of reckoning, though.
Your job, in part, is to manage risk, grow the business. You see Jane Fraser taking a massive construct. Citi's been in constant change since I was a child, but she's doing massive change. Major CEOs of major banks in America are going through change, dropping off on wealth management side. Where's the opportunity for you? Are you happy being who you are? Is there an acquisition trail for you? You may well use the bolt-on acquisition model, but as distress points come in this commercial real estate market and more shoes will drop, are you prepared to sort of stand up and do a deal. Is that your ambition? Is that what you want to do?
Yeah, I mean, we serve our clients. We've been around for 100 years.
Does that mean doing a deal?
Yeah, we make loans. We'll do $2-3 billion of loans this year. All right, we are out there actively still growing the organization. We serve our clients. We've been around for 100 years. We've never had a losing quarter in 100 years, right, with a focus on making sure we serve our clients. Relationship banking. There's only 11 banks our size in the entire country today. So when we ask about are we the right size? Do we serve a purpose? The answer is absolutely yes, and I'm excited about the opportunities for us.
Ira Robbins of Valley National Bank, thank you so much for being with us. Come back soon. Coming up, we've got Liz Young, Head of Investment Strategy at SoFi, Rob Waldner, Chief Fixed Income Strategist at Invesco, Veronica Clark, City Economist, and Scott Keogh, Scout Motors CEO. It is an offshoot of Volkswagen and is looking to create some electric vehicles at a time of incredible transition. We just were speaking with Stellantis' CEO. Right now in markets, you could see that lift continuing as people take a look at the earnings, take a look at the growth, take a look at the strength, the spending of the U.S. Consumer, and keep buying despite concerns about interest rates. Yields lower as people pare back some of those inflation expectations, and crude lower as people take a look at supply that continues to dwarf all demand. From New York, this is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg.
If you look at the Fed, they've been talking about patience, the need for more time, the need for more data.
We still think the Fed will begin cutting late this spring or in the summer, but again, it's just not going to be a straight line.
We think that the Fed is probably going to be on hold here at least until June.
What we're looking at going forward is higher for longer rates, less rate cuts than the market expects.
There's quite a bit more data to come before you get to that June FOMC meeting.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
29 minutes and 20 seconds away from the key data point of the economic dump that we've gotten so far this week. Good morning. Welcome back from New York City for our audience worldwide. This is Bloomberg Surveillance alongside Anne-Marie Hordern as well as Manus Craney. I'm Lisa Abramowitz. Jonathan Farrell off for a well-deserved couple of breaks. I'm not going to call it a sabbatical. I'm not going to say that he's ditching his duties. I'm going to say it's a good thing to take time off when it is deserved. Right now, we are looking at markets that really are kind of treading water. Little bits of gains, a sense of positivity, yields off some of their year's highs. But honestly, Manus, to me, the retail sales number is going to be incredibly important given the incredible strength that we've seen so far and the upside surprise after upside surprise in economic data.
You're going to need the retail sales number to corroborate the dispensing with the showdown that you had in the bond market earlier this week on Wednesday on the back of the CPI. So you had that disruptive moment, hashtag hot according to UBS, it was hashtag hysterical response. So you're going to need a strong retail sales number to help you with this tailwind through.
A strong, but not too strong, a Goldilocks, right? This is sort of the question.
You can't have
of whether,
everything,
well,
Lisa, you can't have it all.
We could try, and that seems to be what markets are looking for at a time when there is this expectation of retail sales at a headline number coming in actually negative, which would be good, given the fact that people are looking for a softening without some sort of mass layoffs. So if you get an upside surprise, when is it too much, man? Is it a good thing?
Well, Gillespie came out, he came out yesterday, really, I think to, send a message that, look, we don't need to get fully to 2% before we start cutting, and actually, can everybody just calm down, please? It's the PCE that matters, not the CPI. And we've had various people react to that, and Mohamed El-Arian is one of those people who has said, that is a folly. That is a folly.
I'm calm. I'm very calm. I am concerned, though, always, because I'm looking at jobless claims, and I'm trying to figure out whether we continue to see a labor market that hangs in there, and whether this is somewhat dissonant, right? At a certain point, if people have jobs and they feel good, they're going to go out and spend, and that creates a potential tailwind to inflation, which is not good. So at what point do you start seeing concerns about a labor market that otherwise have been incredibly strong?
I mean, that's the big question, right? Especially for this White House. When you look at unemployment at 4% or below for 2 years, they know that inflation is hurting American consumers. This is something that they're trying to stem out, especially when they talk about the economy is doing well. What happens if people start to lose their jobs? Then you have higher inflation at the same time, also people losing their jobs. So at the moment, people aren't. At least we are seeing some layoffs, but the data is showing that is still resilient economy.
What I find fascinating is the difference in generations, and that's why I'm actually really excited talking to our next guest, who focuses more on younger investors. And I have to say, if you see younger households, we talk about, doom buying and things of that nature because they can't afford to buy homes because the prices are too high and mortgage rates are too high as well. Anne-Marie, how is that coloring the political discussion as well? Because younger households haven't been able to have and enjoy the same kind of boom of investment returns, of a certain level of housing equity and other types of benefits that this market has provided.
It's this younger generation that's put a lot of pressure on this administration to do things like student loan buybacks, or student loan relief, student loan help, and they're pushing the administration to do more, and they're basically saying to the Biden campaign, we need to see more equity, we need to see more relief, get on the property ladder, be able to pay back our loans in order for us to vote for you. So it is a big deal when you turn about messaging of the economy. There is a bifurcation.
And right now, the bifurcation is playing out in markets as sanguine feel as we head into about an hour and a half away from the trading day. A lift across the board as we retrace from the worst sell-off of the year, at least for the Russell 2000. Quick blip, and then that hysteria died with a quick rebound. What we're seeing right now, S&P futures crossing 5,000, up about 0.1%. Euro gaining some ground versus the dollar, but honestly, a somnolent pair as people play the rate game, the cross-Atlantic rate game, 107.44. 10-year yields, no drama there, down about 3 basis points, 4.22%. And crude lower as people parse through the, 13 million barrels of supply from the U.S. and how that's dwarfing potential demand in places where there is greater weakness. Coming up on this program, SoFi's Liz Young on Wall Street's rate cut reassessment, Scout Motors President and Chief Executive Scott Keogh on the brand's EV revival, and Citigroup's Veronica Clark reacting to breaking U.S. jobless claims and retail sales data as we look ahead to when this economy will disinflate. We begin with our top story, counting down to key economic data, retail sales and jobless claims coming in less than 30 minutes. Investors hoping the data will provide more clues on the Fed's path forward. SoFi's Liz Young saying this, just a few short weeks ago, markets were expecting a total of 6 rate cuts beginning in March. Current pricing shows 4 cuts, not beginning until June. That was fast. Stocks have not yet shown much fear over delaying the first rate cut, nor the persistent yield volatility, although I do find this peculiar. The reality is people are still buying, or at least the very least, they're holding. Liz, I'm pleased to say, joins us now. Liz, do you think that this is sort of a sign of the strength of what's to come, or do you think that this is a cautionary tale of overexuberance?
Well, I think if you look at just the state of the state right now, there is a lot of very classic late cycle behavior going on. And obviously we've seen a resilient market, perhaps not as strong of a rally as we saw at the end of last year, but resilience in the face of what would have been considered bad news. So the rally at the end of last year predicated mainly on the idea that we thought the Fed would come back and pump liquidity in, lower rates starting in March. And investors got really excited about that because it sent the message that we could then support valuations at this level. So slowly in 2024, we're chipping away at that thesis. Can we support valuations at this level? If cuts come later in the year than we were expecting, I would say the answer to that is probably no. Some of the data, however, continues to be strong. We've got GDP data that continues to be strong. So at this point, investors haven't yet gotten enough bad data to feel like they needed to exit markets. That's why I say there's still buying appetite there. If even just after what's happened this week, we saw that huge sell-off on Tuesday in reaction to CPI, but that was it. It was one day. It hasn't recovered all of it yet, but you did see some buying come in even at the end of the day on Tuesday, and then we had marginally up yesterday. We look like we're going to do okay this morning so far. So there hasn't been this lasting fear that's baked in yet.
And you're basically suggesting that people should be a little bit more worried, that there will be more ripples felt if rate cuts are pushed out, and if you do expect higher for longer. What's been the response when you tell people to be more cautious?
You know, it's interesting. I think intellectually, people agree that we're not really sure what's happening. And frankly, if you look at 2024, it feels like the uncertainty this year seems to be higher than it was last year and even in 2022. At least we knew in both of those years what path we were on from the Fed. 2024 seems to be very uncertain, and we're hanging on data that we haven't paid as much attention to in the past. So now we're hanging on labor data. We're hanging on consumer spending data. We're a little bit concerned about credit card delinquency rates that have been rising. So I think people agree with the idea that they have to be more cautious. But again, this late cycle behavior in the market just breeds FOMO. And you watch these stocks run up and everybody still, it doesn't really have a reason to not believe in the momentum train. So momentum has been very, very strong. Investors continue to see that. And there hasn't been a big enough reason to jump out of the market and not take part so far.
Liz, good morning to you. And I think one of the phrases that we had over Christmas time on this show was weaponized FOMO, and it really does feel like that. We talk about jobless claims, to get those, we'll get the retail sales. So they are uniquely important fingerprints of what's going on in the economy. But then I just wonder, have stock reports almost taken on similar kind of heft? We talked about NVIDIA over the past couple of hours, up 49% on the year, taking over Alphabet, taking over Amazon. And it has got the capacity to shift this sort of exuberance at the Magnificent Seven level. Do you think that this is a dangerous sort of zeitgeist in the market where we are, that we're going to be so focused on one stock, one report, defining our sentiment?
Well, that much concentration is always a little bit dangerous. And yes, I would caution investors, especially in some of those names. I think the Magnificent Seven has now turned into the Magnificent Four. But when you're looking at even just those four, and there's been this huge run up, you've got triple-digit gains in those names, it is something to take heed. You should make sure that you're not overly exposed to that. But here's the good part about hinging on some of these reports. We want the market to trade on stock fundamentals. If that's the case, I think that's a much healthier market environment than a market that's overly sensitive to every single macro data print. The other piece of that is, if NVIDIA, for example, in the space that they're in, let's say they come out and give guidance that's different than people were expecting, the risk, because we're listening so closely to one name, is that that one name bleeds over into the entire sector or the entire industry group. And that's what I think investors are overly concentrated in. So we're hinging off one company's reports to tell us what's going to happen in the rest of the entire group. And I don't think that that's entirely the right way to look at it. So I'd like to get through next week and have it just be done, have it be over with, survive it, and then start to get back to a more rational environment where we're expecting rate cuts at a normal time, not too soon, not necessarily too late, and starting to think about, okay, what do earnings look like through the rest of the year? Because earnings expectations on the whole are still pretty lofty for 2024. I would still expect some of those to be revised downward.
I love a more rational market. I love that. The earnings are going to be driven, I presume, in part by the ability to sustain margins. One of the big arguments coming through my inbox is about wages being higher, wages, again, eating into those margins. We just saw Stellantis. We had a conversation with the CEO there. They're giving away $30 billion, and they just did a huge pay deal with their employees, the UAW union workers. How do you see margins, and I know it's different sectors, different margins, but how important will that be to solidify, if I can use that word, the rally in equities?
Well, I've had an issue with margins and the story about margins for a while now, because the math of it for me just doesn't really work. If we're expecting, or if the Fed is expecting, less than 2% GDP growth, I'm having a hard time figuring out where 11 to 12% earnings growth is going to come from. And you're talking about the wage story and that eating into costs for companies. That absolutely is true. That's been able to be absorbed through 2023 and even parts of 2022 because companies were raising prices. So they were able to raise prices and raise revenue in order to offset the increased cost from wages. Now we're at a point where the cat's out of the bag, inflation has come down. So there's no more justification to raise prices. The issue for consumers is that companies haven't really dropped prices. So we're still at an elevated level. We just stopped raising them so much. But if wages continue to rise, that will eat into margins. It does pressure companies. So then they have to go back and say, if I want to preserve my margin, I'm going to have to cut costs somewhere. It's been my take that companies have cut a lot of costs already. We've seen a lot of cuts in advertising. We've seen labor cuts. We saw tech companies make a bunch of cuts over a year ago. So at this point, what's left? The things that are left to cut are typically labor. It's the last thing that companies want to cut, but that is at risk, I think, in 2024. And I heard a guest earlier in the program talking about the consumer is still spending, the consumer is still strong because the labor market is still strong. That is absolutely true. The risk with that take, too, though, is that the labor market is always the last thing to crack. So the labor market right now is strong. That doesn't mean that it's going to stay strong if companies are trying to preserve those margins. And you have to think about the entire thesis all the way through. how that's actually going to work out in the math equation.
Which is a reason why some people are more focused on jobless claims than they are even retail sales. Liz Young of SoFi, thank you so much for being with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahaira Hakis. Yahaira.
Hi, Lisa. According to Bloomberg, U.S. intelligence believes Russia is considering a nuclear weapon in space. The news comes after House Intel Chair Mike Turner warned the public of an unspecified national security threat and demanded the White House declassify related material. U.S. National Security Advisor Jake Sullivan is expected to meet with members of the Gang of Eight today to provide more details. When asked yesterday, Sullivan said he was unable to comment further. Bitcoin is once again powering the crypto market, climbing past $52,000. The move is part of a broader rally that sent Ether back above where it was before the Terra USD stablecoin collapse 2 years ago. Bitcoin has surged 22% year to date, pushing its market cap above $1 trillion for the first time since December 2021. Cryptocurrencies have been gaining momentum thanks to the debut of Bitcoin ETFs. For the second time this year, a U.S. company will try to put a spacecraft on the moon. The Nova C moon lander, built by Houston-based Intuitive Machines, took off from the Kennedy Space Center this morning on a SpaceX rocket. It will attempt to land on the moon in about a week, and if successful, it will be the first privately built lander on the lunar surface. The mission comes after failed attempts by companies from Israel and Japan. That's your Bloomberg brief. Lisa?
Yahaira, thank you so much. Up next, electric vehicle makers expanding despite challenges.
Right now, we know that we have a challenge on affordability. Affordability means that we need to absorb the additional cost of the EV technology.
That's next. You're watching Bloomberg Surveillance.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance, taking a look at markets with a lift with just about 13 minutes to go before key economic data. Yields lower, as is crude at a time when people are wondering about demand. Let's get straight into it. Under surveillance this morning, EV makers expanding despite challenges.
Right now, we know that we have a challenge on affordability. Affordability means that we need to absorb the additional cost of the EV technology. It's around 30 to 40%. So we need to absorb it. And we need to absorb it by a better design to cost, by more efficiency in everything we do, in our plants, in our supply chain, in our logistics.
Here's the latest. VW subsidiary Scout Motors, expanding electric vehicle production in the United States, has headwinds, including price, infrastructure, and mass market adoption, impact both legacy brands and startups. Joining us now, I'm very pleased to say, Scott Keogh, President and CEO of Scout Motors, in front of the new proposed manufacturing plant in South Carolina. Scott, I just want to start with why you want to get into electric vehicle making at a time when so many larger auto manufacturers are trying to get out.
Yeah, look, it's a long game, and we're not playing the short game. So I think a few wind noises, a few disruptions is not where the action's at. The market's at 8% now. It's going to move to 40 to 50%. That's millions and millions of cars. So the upside is there is an opportunity, and we want to pursue that opportunity.
You're building something in the United States, which is, I'm assuming, deliberate in response to some of the recent policies. And I'm just wondering how difficult it's going to be to compete with China at a time where costs elsewhere are more expensive, both with labor, both with also some of the actual raw materials based on where they come from.
Yeah, look, competition is what we're used to. That's what the automotive business is about. I think if you look at what Scout Motors is doing, frankly, the strategy is nearly perfect. America is a huge market. We're building things again in America, which is exactly what we're doing here. We're localizing the supply chain and attacking cost. I think the fact we're starting with a clean slate, we've got the purchasing power of the Volkswagen Group to give us good terms of trade on cost. To me, it's simple. You have to compete, but that's why we have a ground-up platform, ground-up factory, design everything to compete on cost and make a great vehicle.
Scott, good morning. Good to see you. I got to say, the design looks great. Who are you? I've done a little bit of this desert bashing, dune bashing when I lived in another country. So I sort of know the style of car, and it's great fun. Yep. But how big can this market get for you here in the United States of America? Tell me the model that you're going head-to-head with. Is it Ford Bronco? Is it the Wrangler? Who are you going to compete with in this space?
Yeah, I think you're certainly in the zone. Look, in my mind, there's two types of SUVs, RUVs in the market, if you will. There's mainstream, dialed to going around town, going into suburbs, going into the malls. Then there's can-do types of vehicles. Look, at the high end, things like the Defender. At the more medium end, Broncos and Wranglers. What do these vehicles have? Strong community, strong loyalty.
But where are you going to make the most money? Where are you going to make the most money? At the upper end or at the, probably my end?
Right down the middle. We're building a car. We're building a car for mainstream America. We're going to price it in the zone of $50,000, and that's where we're going to make our money. And we can make our money at those price points, which is great. If someone wants to equip the car higher, then that's obviously fantastic for margins. But you have to make money on the base, not just at the high end.
To get some of the tax relief from the U.S. government, though, a lot of what you put in your car needs to be made in the United States or a U.S. ally. But when you look at how batteries are made for EVs, the entire raw materials and the supply chain to make that battery, the processing comes from China. What's the mix in your cars?
Yeah, look, we haven't fully identified everything, but I think, look, it's simple if you look at the incentives. There's the consumer side, which is what you've mentioned, then there's the industrial side, where you make it, the power, the cells, and everything else. So look, our goal is to take maximum advantage of all the incentives on the table. There's a strategic opportunity in America now. That opportunity is going to last for a couple of years, and obviously, we want to take advantage of it. Do we have every last detail laid out? No, but our goal is to seize the moment. And by the way, there's a lot of people seizing the moment. I think if you look at the amount of industrialization that's happening in America, it's through the roof. Lots of companies see it. It's a chance of a lifetime, frankly, and that's why we're pressing our advantage and pressing it now.
The Stellantis CEO recently talked about the fact that he's staying on the sidelines when it comes to how he's going to deploy the money he has for EVs, depending on the upcoming U.S. election. Do you plan on potentially changing the path forward for your company, depending on who wins the White House in November?
No, I think the North Star is the same. The North Star is build a great electric vehicle, build it in America, make a product and a brand that Americans love. That's a North Star, and that will go for centuries and decades. You can't run a business on the movements and shifts of politics, but at the end of the day, the money is going towards American jobs, American manufacturing, and I think Americans support that. And you see it across the board. So I think the core infrastructure will stay there, but we will run our business based on the consumer and based on getting the cost right, not just on political movements.
Do you think that if there were no tariffs, if there were no barriers on Chinese electric vehicles coming into the United States, that U.S. auto manufacturers could compete when it comes to selling EVs?
Look, this is conjecture and speculation, if this could happen, if that could happen. Frankly, The automotive business in America has been here for a long time. It's competed for a long time. I think if you look at the type of vehicle that we're making and the person that it's targeted for, I think they're going to love a Scout. They're going to love what we're offering, the technology that we're offering. But it's simple. You do need to compete, and we will. And there's been competitive threats that come across the globe from all sorts of countries. And I think America is used to competing, and America will compete. But the smart thing about this brand is make a product that Americans love. I haven't seen it out there yet, and that's why we're making it.
What do you think so far, Scott, the barrier has been with respect to electric vehicle sales and why they haven't taken off as quickly as so many people have expected in the U.S.?
Yeah, look, I think there's a fair amount of noise. Before you say Disasterville is here, you know, first and foremost, 1 million of them were sold last year. That's 8% of the market. It was 0 just a little bit ago. I think there's 3 things without a doubt that we're focused on, and everyone is. Absolutely right. The double hit of material cost increase plus the financing charges. Financing alone put $250 a month on every car payment. So when we head into this, let's say, a more normalized inflation environment, look at the cost of batteries. They're going down dramatically. So cost is number 1. Number 2 is infrastructure. When we come to the market, there'll be 10 times more chargers in America than there are today. Infrastructure's there. Third and final is the standard. As you know, there's been no standard. There's 3 to 4 different ones. Now, rallying around NACS, there'll be one standard. So these are all big things. And the other one is just classic adoption. Get the cars on the road, get them seen. That's purchase confirmation, and away we go. What I haven't seen is the consumer saying, I don't like them. The consumer saying, these are cool, I do like them. So that's the thing you need to attack. The rest is classic adoption challenges. We need to address them big time.
Scott Keogh, thank you so much for being with us, President and CEO of Scout Motors. Meanwhile, we are about a minute away from, or actually about 5 minutes away from some key economic data, breaking retail sales and jobless claims. We're going to be speaking with Citigroup's Veronica Clark to react to those numbers. The expectation is for some sort of ongoing, just sort of slow grind of initial jobless claims, 220,000. We are expecting a negative headline retail sales figure, although when you strip out autos and gas, the expectation is for it to just eke out a slight gain, the Goldilocks that so many people are talking about. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Just about 25 seconds until key economic data. What is more important, and this is going to be something that we're going to be talking about, is it retail sales that we're going to be getting, or is it initial jobless claims at a time where people say the key really is about the labor market? Right now, the expectation is for 220,000 initial jobless claims. The expectation is for a headline decline of retail sales of 0.2%. When you look across the board, the key question will be, will there be ongoing strength? Joining us now to break it all down is Michael McKee, Bloomberg Economics and Policy correspondent in Washington, D.C. Mike, what do you see?
Well, we were expecting bad news on retail sales, and the news is worse than we anticipated, down 0.8%. The forecast was for a 0.2 decline. About half the country was under piles of snow during January. That may have had something to do with it. Ex-autos down 0.6%. And the control group down 0.4. That was expected to rise by 0.2. So not good news anywhere in the retail sales report so far. Jobless claims come in at 212,000. They drop from a revised 220. So better news on that front. Continuing claims at 1,895,000 do rise by 30,000 during the month. So people may be slower getting jobs, but that is 2 weeks delayed. So today's drop in last week's claims hasn't made it into that yet. The Philly Fed comes in higher, 5.2%. We were looking for a negative 8.1, so good news on Philly Fed. Import prices up 0.8 on a month-over-month basis. On a year-over-year basis, they're down 1.3%. So some inflation pressure on a monthly basis not working its way so far into the year-over-year numbers. And finally, in this palooza of data, Empire Manufacturing, negative 2.4, still negative, but that's better than the negative 43.7 that we saw in the month of January. So an awful lot of numbers, and what I will do here is go through it and break down some of the retail sales numbers, Lisa, while you break down how the market's reacting to all of this.
I'm looking forward to hearing what you parse through. Just taking a look at markets, it's kind of as you would expect, given the fact that you get a downside surprise. You get a lift to equities because good news is bad news. Actually, there's basically no change whatsoever because it doesn't change the picture. The Fed is going to be on a cutting bias, and that is going to give a bit of reprieve. S&P futures up still 0.1%. Same with the NASDAQ. If you could actually see a bigger pop in the Russell 2000, which is as you would expect, given the fact that it's more rate sensitive. Talking about rate sensitivity, bleed it through the rate market, and what you see, yields lower, not that much lower, but still lower than where they were on the session, down 5 basis points, 420 on the 10-year. 2-year yields, 453, down also about 5 basis points. People looking forward and seeing more likelihood that if people are spending less, maybe the Fed can cut rates sooner than maybe they were expecting when we got the CPI print. When you translate it into a foreign exchange call, you could see a weaker dollar, stronger euro, weaker dollar, stronger pound. It's almost down to flat on the day with the pound, even after the pound reeled on the face of a UK potential technical recession. 125.63 on that pound dollar cross, and the euro up a little bit more, 107.64. Mike, you've been parsing through the numbers. There is this question of it all comes down to jobs. If people have jobs, they'll keep spending. That's what everyone's been saying. So what went wrong in January that caused a much bigger than expected decline?
Well, it does look like the theory that the weather played a big role really did hold true here. The biggest declining category was building materials, home garden supply dealers down 4.1%. I suspect that's because nobody was working outside and maybe they already had enough snow shovels. So we saw a big decline there. We see smaller declines across the board in other places. Of course, gasoline prices went down, so gas station sales down 1.7%. Furniture stores were up, however, as were food and beverage stores, up slightly, 0.1% for food and beverage stores. And then you look down the list, and general merchandise stores, department stores, little changed. Non-store retailers were down 0.8%. Food and drinking places, though, up 0.7%. So perhaps it was the weather, perhaps it was a little bit of exhaustion from spending all that money in November and December. Of course, the thing to realize always with retail sales is it's very volatile. They will be revising it next month. As a matter of fact, retail sales were reported up 0.6 in the month of December. That was revised down to 0.4. So not a good start with retail sales for February, but the jobless claims numbers suggest companies are not reacting to that.
Well, let's just talk about those jobless claims. Weekly jobless claims, Mike, good morning. Down 8,000 to 212,000, so it's below the estimate. Julian Emmanuel was with us this morning. He said this is the single most important print every week that we need to keep an eye on. So this is still very well behaved, isn't it?
It is. It does give us an indication of what companies are thinking on a fairly timely basis. Of course, we have to realize that jobless claims are always revised heavily. So while we're at 212, it could easily go up or down a little bit when we get new numbers next week. And as I mentioned earlier, the continuing claims numbers really haven't moved all that much. We did see an increase in claims the prior week, and that's what that continuing claims is based on. This week we go down, so continuing claims probably go down next week. Overall, though, it does show the labor market remains healthy, and as Lisa said, people spend when they have paychecks, and that's been a reason we've seen strong spending up until this month.
Michael McKee, thank you so much. We'll be catching up with you throughout the day to understand more details as they come out. Veronica Clark, Citigroup economist, joining us now. And I got to say, Veronica, how do you make sense of numbers that just are kind of disparate? They don't necessarily cohere with one another.
Yeah, I mean, in one sense, you know, these numbers for December and January are always going to be a bit hard to interpret, maybe because of weather, but also just large seasonal adjustment issues around the holidays. I wouldn't necessarily read so much into this weaker retail sales report. You know, we have had a string of 6-7 months where we've been surprising to the upside. The consumer has been very strong, and maybe there's those seasonal adjustment issues, but we are watching for signs that things are starting to slow down, and maybe this is the early indication of that.
At the same time, jobless claims arguably is even more important. We're not seeing it tick up. If anything, it's coming down. How much does that color your perception of the weakening that's supposed to happen, but just hasn't shown up in things like CPI and things like jobless claims and even things with other metrics like job openings?
Yeah, that weekly jobless claims number is definitely the most important to be watching, and initial claims are still very low, and that's consistent with what we've seen for many months now, where layoffs, outright, widespread layoffs are really not quite happening yet, at least in terms of the data. We have seen this increase in continuing claims, though, especially after the reference week for that January payrolls report. So those are ticking a bit higher, and I think that's consistent with what we've seen in hiring slowing down. If you do lose your job, maybe it is taking you longer to find work, which could be the early sign that broader things are slowing down also. So definitely still watching that initial jobless claims number. If that really starts to tick up, then that would be a turning point.
Good morning, Veronica. I'm curious to understand, you still have a call for a recession, and yet you look at the survey data, and I know you can hurl eggs at the screen on survey data, but the survey in the Bank of America Fund Managers Survey is the first time in a number of years that call for recession has ceased. So why are you at the other side of that trade?
Yeah, I mean, I think one issue is that, it comes down to, do you believe, this high level of rates is restrictive or not? And we do think it is. And the longer that, financial conditions stay tight and rates are restrictive, you will see that, impact activity and see things slow down. And we did see the early signs of that really back in October, November. We've seen the unemployment rate ticking up very slowly, hiring slowing down, hours worked that are falling, all those early signs that you would expect to see, 6 or 9 months before a recession. And we're really watching the data for the spring to see if that turns around. Again, because some of this December, January data has issues with seasonal adjustment and it might be hard to read into. But nothing has convincingly, told us yet that weakening isn't happening.
We've had severe whiplash this week in equity markets, bond markets, and we've been guided by the Fed that the only thing that matters is the PCE, or it is perhaps the more important facet for us to keep an eye on. Should we completely ignore what happened in CPI and go, it's a one-off, it's not where we should be focused?
No, I don't think that's right. I mean, I do think, we did see some pretty genuine strength in CPI. And yes, the Fed is targeting core PCE inflation. We've had about 6 months where that's running at around, 2%, 1.9. That story, though, might change in 2 weeks when we get a stronger PCE report for January now, because those elements of strong CPI are going to go into that PCE number. But I do think, we saw some pretty genuine strength, just very consistent, strong services inflation. And that's in, shelter prices and non-shelter services. I think it is telling you that companies experienced larger than usual labor cost increases over the last year, 4 to 5% wage growth, and they are still passing that on to higher prices.
Tell me, are you a believer in the evangelist movement that AI is going to deliver such phenomenal productivity gains as we saw during the Greenspan era, which was referred to as the new paradigm? Do you believe in this productivity nirvana that's being proposed to us? Maybe it's real, maybe it will come in time. Your take?
Yeah, I don't have a strong opinion on it yet, but if we do get these big productivity gains from AI, it probably would really be over the longer medium term. I don't think that's a story for this year. We have had very strong measured productivity growth in the last year, very strong activity, but I think that's also just kind of making up for this bumpiness that we've experienced in a lot of the macro data the last 4 years.
Veronica, you've had a really bold call, and I've really been struck by how much you and Andrew Hollenhorst have really doubled down on this idea that this is a hotter than expected inflationary kind of environment that's going to require a much longer period of time, that the Fed has to hold rates where they are. It's going to lead to a hard landing. How much have you pushed back your timeline for how long the Fed's going to have to hold rates high?
Yeah, I mean, it does seem like the Fed is pretty set on cutting rates this year. Our base case is that we'll see that first cut in June. And I think there's a number of ways that even with stronger inflation data, they can get there. On a year-on-year basis, core PCE probably does look a lot better by the time of the June meeting, even if the monthly prints, stay a bit stronger than comfortable. So I do think they are cutting. But yeah, we've been, fairly firmly in the not soft landing camp. I do think you need to see a broader slowdown to really actually get 2% inflation.
So in other words, have you pushed back your expectation for when the Fed's going to cut, or does that sort of matter less than just sort of the cumulative effect of rates where they are, as they have been over the past couple of years?
Yeah, we haven't really pushed back that expectation at all. I mean, I know markets a month ago were pricing, a cut as soon as March. We've always been much more middle of the year. We still expect that cut coming in June. The question is that, 6 months, period until we get there, less than 6 months at this point, is that going to keep financial conditions tight enough to actually slow things down? It may not. If it doesn't, though, I expect you're still seeing some uncomfortably high inflation data.
Veronica Clark of Citigroup, thank you so much for being with us. Let's get an update on stories elsewhere this morning. Here with your Bloomberg Brief is Yahaira Hakis. Yahaira.
Hi, Lisa. Colorado is the second state suing to block Kroger's $25 billion acquisition of Albertsons. State Attorney General Phil Weiser is seeking a preliminary injunction that would prevent the deal from closing. He says the merger would leave some Colorado communities with less access to groceries. The move comes just a month after Washington filed a lawsuit over the deal. The FTC has been reviewing the proposed takeover for over a year. NVIDIA's scorching rally continues, with the chip maker surpassing Alphabet's market value. It comes just one day after the company overtook Amazon's market cap. The chip giant is up 49% this year, with the company now worth $1.83 trillion, making it the world's fourth most valuable company after Microsoft, Apple, and Saudi Aramco. SpaceX is officially looking to move its location from Delaware to Texas. Yesterday's filing would make the latest Elon Musk venture to ditch Delaware. Neuralink was reincorporated in Nevada earlier this month. Musk's criticism of the states comes after a judge struck down his $56 billion pay package for his role as Tesla CEO. Musk is threatening to ask shareholders to incorporate Tesla in Texas as well. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I got to say, Anne-Marie, he was saying that he was going to do it. Everyone said, yeah, of course you're going to say that, but everybody incorporates in Delaware. Is this sort of the beginning?
And then he did it.
Yeah, exactly.
Yeah. But he did it with SpaceX. The problem is, can he do it with Tesla, given it's a publicly traded company? But he's encouraging more. And he's, calling Governor Abbott and saying, we're all going to be moving to Texas.
Let's see how much this is sort of lip service versus actual call to action. Up next, investors parsing through disappointing retail sales and what it will mean for the Federal Reserve. Rob Waldner of Invesco joining us next. You're watching Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, Anne-Marie Herdern. Anne-Marie Herdern is here. Manus Cranny is here. Jonathan Farrow is not, but he will be back next week. We are parsing through retail sales data as it comes in much lower than expected. Here's the latest. January retail sales coming in down 0.8%. Estimates were calling for a decrease of 0.2%. Futures rising, bond yields falling on the news, I guess. Good news is good news. Bad news is good news. Everything's good news. S&P futures up 0.2%. The euro gaining versus the dollar just a bit more, 107.66. You get a bit of ongoing strength in treasuries. Yields lower, down now almost 6 basis points in the 10-year, 4.1968%, rounded to the nearest fourth. But what I'm looking at right now is just how this really translates into a longer-term view of a market that was really on the brink of overheating when we got CPI data, then just sort of dashed, and now a question of who do you trust when it comes to the economic data providers? Rob Waldner, Chief Fixed Income Strategist and Head of Macro Research at Invesco, joining us now. Rob, what do you make of this data that we just got?
Hi, Lisa. Well, I think if you add this data that we got today, which is the retail sales, which are disappointing, some of the regional industrial surveys are a bit better, and then you add that to the CPI data that we got early this week, we're just getting a lot of noisy data today, probably impacted by seasonal somewhat, but I think it's all fits within this bigger context where we think the U.S. economy continues to move forward with decent growth. And we have seen the highs in inflation. We're in a disinflationary environment, but as the CPI data pointed out, as we get close, as CPI continues to come down, disinflation continues, the last few bits of disinflation will probably be slower and bumpier than we saw earlier throughout much of last year.
I'm struck by which data point's more important, the initial jobless claims or retail sales. We were talking to Veronica Clark over at Citigroup, and she said, honestly, it's the jobless claims. It's the fact that we still see that health in the labor market, and as long as that's the case, you are going to have a risk of inflation having a much bumpier path down to 2%, to use your parlance. So at what point do you start gaming out a June, a July, a September rate cut as the first from a Federal Reserve that seems to be pretty patient?
Well, I think I would agree that the labor market here is very key to look at. Retail sales, there's a lot of seasonality this month. Credit card spending still seems to be okay. So I think looking at the labor market is key here. We do see signs of labor hoarding. So that has kept, I think, income stronger for people than typically we've seen at this part of the year. So I would look for that labor market for jobless claims. But with the kind of level of growth that we have, and if this disinflation continues that we think, and of course the CPI data this week added some uncertainty there, but we think the trend is still towards disinflation. The Fed will probably be cutting in May or June.
Good morning to you, Rob. May or June? Well, that's a little bit ahead of where the market managed to push the rate expectation to just the other day. They pushed it all the way into July. And given the landscape that you're looking at the moment, delinquencies are not high. We've just had the CEO of Valley Bank in here. He's talking about measured delinquencies, not that worried about his commercial real estate exposure, etc. You still quite like credit. Just lay that out, because those spreads are tight.
There is a basic conundrum here, right? Which is that the macro backdrop is very positive. So steady growth, disinflation, Fed moving towards cuts, very good macro backdrop for all markets, which is why you see credit spreads are tight, equities are doing well, and the technicals in credit are very strong. There's tremendous demand for credit in our view. But you point out valuations are very tight. We're 10 basis points off the GFC tights for investment-grade credit spreads. But I think the thing that we need to remember is what matters to end investors is the all-in yield. And you can get something close to 5.35 or so in investment-grade credit today. Over any longer-term period, I think that generally looks quite attractive.
That actually looks quite attractive to me. If I'm sitting in a CD and I go and get 5.35 on an investment-grade credit note, then when it comes to the $6 trillion that's parked in money market funds, the migration of that money will be much debated long after I'm gone back to Bloomberg Brief and off surveillance. But that flow of money, do you think it goes more to equity than it does to credit, or vice versa, given that kind of yield that's on offer there at the moment?
Well, you point out that we have the $6 trillion out there that when the Fed starts to cut, we'll start to realize, the rate that they're getting paid in those money markets will come down, and that money will flow out first to fixed income, and eventually to equities. But, first to fixed income, and I think high quality credit, that's one of the reasons why it's so well supported here, is that if you can lock in for a longer period of time, high quality credit at better than you get in your money market, now is a good time to do that.
Okay, so if the flow goes to credit first of all, or into credit, as you say, and then equities, it's not going to all flow in all at once. It took a considerable period of time for incidences to arise to put that money into money market funds. One was yield, but two was also idiosyncratic risk in regional banking. So what portion will cash play as a defense mechanism for the rest of 2024? Because we've got some hot geopolitics, we've got an election coming up.
Yeah, we need to watch carefully, because you pointed out the amount that's in money market funds, but actually it's still been growing, right? So even now, with the Fed sort of said they're done expecting a rate cut, it has still been growing. The balance is in money market funds. So it's not that there's been massive flow out yet. So the question is, when does that start in any substantive way? And I think that's probably when the Fed starts to cut rates, because to your point, cash is a very safe asset in that it's basically government credit, and you're getting a good yield for government credit. The only risk in money market funds is reinvestment risk. And once you start to realize that reinvestment risk, that's when investors will be motivated to look for other alternatives, in our view.
Rob, we just got remarks from Director Lael Brainerd of the White House, prepared remarks she's going to give today. And she talks about disinflation as following that the United States is experiencing a stronger recovery and faster disinflation than our peers. And we wake up, Japan falls into recession, the United Kingdom falls into recession. When will all of this catch up to the United States?
That's a great question, Anne-Marie, because, you know, the U.S. just seems to be well ahead of most other countries. You pointed out that the UK data today points to very tepid, unexciting. Chinese growth has been unexciting, and is now, the Chinese economy is now in outright deflation, both at PPI and CPI level. So in the U.S. here, we've had continued steady, good nominal GDP growth, really outpacing the rest of the world very substantially. So what the end game is there is hard to know, but it certainly involves the Fed getting through this starting into this rate cut cycle in an environment where the dollar, some of the pressure can come out of the dollar can come off, and that's probably supportive for growth elsewhere.
Just 20 seconds, Rob. What's your most contrarian bet right now?
What is the most contrarian bet right now?
Yours, yes.
Well, I think that's a great question. I think that the contrarian bet would be that we get a recession and rates rally very substantially. Then, you know, there certainly is. That was the narrative at the beginning of last year. If that develops again this year, it's not the consensus, but it's certainly a risk.
That's really interesting, Rob. Thank you so much for being with us. Always wonderful to get your thoughts. Rob Waldner there of Invesco. Coming up tomorrow, Sarah Hunt of Alpine Saxon Woods, Greg Valliere of AGF Investments, JP Morgan's Kelsey Barrow, and Steve Rasciuto of Mizuho. Manis, thank you so much for being with us. You'll be joining us again tomorrow.
Day 2.
Exactly. And we'll be plowing forward with you, Mish Sentiment Survey. Have you gotten the call yet, Anne-Marie?
I have not yet, not gotten the call. I also want to be on the other end of those.
Yeah, you think that would you also do what John does, which is basically come up with really kind of skewed projections
and then see if it shows up, see how much of an impact it made in the survey.
Do you think he just saber rattles?
Yeah, I think that basically you just look at gasoline prices and then you plot out your feelings and then it works through.
Yep.
That's up next. This is Bloomberg Surveillance.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. World of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's
is now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
From New York City for our viewers worldwide, I'm Danny Berger in for Jonathan Farrow. A surprisingly calm market over the past 24 hours after that CPI surprise on Tuesday. Bonds are bid, stock futures are bid with the help of weaker retail sales data. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
Coming up, U.S. retail sales dropped by the most in nearly a year, raising questions about the health of the consumer and reigniting the Fed rate cuts, the case for it this year. We begin with the big issue, is the consumer starting to crack?
I wouldn't necessarily read so much into this weaker retail sales report. You know, we have had a string of 6-7 months where we've been surprising to the upside. The consumer has been very strong, and maybe there's those seasonal adjustment issues, but we are watching for signs that things are starting to slow down, and maybe this is the early indication of that.
Let's get right into the results. Joining us is Bloomberg's Mike McKee. Mike, it comes in at a negative 0.8%, more than expected.
Definitely. We were expecting a 0.2 decline on the month. Instead, we get an 0.8 decline, and we get December revised down a little. Now, there's going to be a lot of talk about it being a weather-related event and also perhaps some payback for what we saw during the month of December. Fairly strong numbers, but it's still not great news for the economy overall. Retail control sales in particular were down 0.4% after an 0.8 gain the month before. Retail control is what goes into GDP. There was good news on the jobless claims front. 212,000 down 8,000 suggests companies may not be reacting to a slowdown in the economy. But then there's also some bad news in the price numbers that we got. Import prices up 0.8. That's the first increase since early last year, and it's the strongest increase since 2022. On a year-over-year basis, import prices are still down 1.3%, but they were down 2.4%. So some inflation pressure coming in from overseas, and this is not just oil, it's goods as well. Philadelphia Fed, while the headline improved, the prices paid number got worse. Not tremendously, but a little bit worse. And Empire Manufacturing gets a little bit better as well, but still prices paid an issue there. Retail sales, for the most part, are at this point a disappointment, as you can see with the blue and the white lines down there. The question is, what does it do to that yellow line? That's the Atlanta Fed's GDP Now number, and of course, it's just based on January data for the most part, but it should be pulled down significantly. We'll get an update on that later today, and it does look like the first quarter, based on consumer spending, since it's such a big part of the economy, the first quarter is going to be much slower, perhaps, perhaps than the fourth quarter and certainly the third quarter. And then finally, you want to take a look at what is going on with overall jobs and prices. And at this point, what we're seeing is the import prices and the Philadelphia Fed prices rising, and so unfortunately, this is going to raise questions at the Fed. The issue is, if the economy is slowing, does that mean that these prices will fall back and we're not going to have to worry about it? That's the debate over the next couple months to come, Danny.
Mike, it certainly feels like choose your own adventure data. You can make basically whatever narrative you want out of that. Mike, thanks so much. Michael McKee there breaking down the numbers. Let's continue the conversation. Joining us now is JP Morgan's Jay Barry and John Hancock's Matt Miskin. Matt, let me start with you. We had weaker retail sales data, 0.8% decline. Estimate was 0.2. You matched that with CPI on Tuesday that came in hot. How are we supposed to be data dependent when the data is sending such mixed signals?
Yeah, as you say, Danny, we got to choose our own adventure here, right? But at the end of the day, think about retail sales. That's nominal. So that high inflation is embedded in it actually is helping the retail sales number. You strip that out and you think about the real retail sales, that's not great. We think actually end of last year, consumers really went on credit and levered up a bit to have good holiday shopping on the midst of a good stock market. But the cost of capital is still very elevated and mortgage rates have ticked back up. We're seeing mortgage demand slip again. And we think the Fed is going to be pushing back on this economy after a really good run in the last several months. We think that it's going to decelerate here. And equities are frothy in parts, and there's some bubble-like tendencies we're seeing in markets. We would trim that here and redeploy into higher quality parts of the market.
Jay, would you agree with that? It's a consumer that's cracking, a decelerating economy that the Fed's going to have to push back on?
Morning, Danny. I would sort of push back a tiny bit. We don't think the consumer is cracking, but merely normalizing here. But we do agree that growth is slowing, and I think after strongly above trend growth at the end of last year, amid all the volatility that we've seen in the data flow the last few weeks, it does indicate to us that consumption's probably normalizing closer to a 2% pace in the first quarter. So if that's the case, it means that we're downshifting, we think, towards below trend growth, but not necessarily cracking from right here. And if anything, that is supportive of a Fed that will begin easing at some point later this year. We continue to look for the Fed to start easing in June, and certainly the market's expectations have been pushed back over the last couple of weeks, but we think this is reflective of that sort of outcome.
Yeah, you're not the only one. Barclays and BNP both writing that they're shifting their outlook to June to be the date that rate cuts start to happen, but we can't forget that hot CPI data. At least that's what Mohamed El-Arian says. I want to bring you draw both of your attention to what he wrote in Bloomberg Opinion, saying that it's a wake-up call. Resist the temptation to dismiss the market and media narrative reaction as a storm in a teacup. Instead, we should see the reactions as a wake-up call for traders, investors, and economists. In other words, we might not be so quick to cut, and to be so quick to cut forcefully. Matt, do you think it's a mistake for markets to brush this off and continue to buy like that CPI data didn't happen?
The thing with the CPI report is 70% of it was shelter and housing and rents. And if you look at the Zillow data or you look at the rent.com data, it is showing much lower inflation than what the Bureau of Labor Statistics is putting out. And what we're likely to see is the shelter component is going to decelerate here over the next several months. I don't think that report was the end of the world. It's basically 0.1% over estimates. And again, it was all shelter. So you strip that out, and I know we don't like stripping out CPI components. I know that's a negative, but if shelter's 70% and you know that's a lag data point, maybe it's not as bad as we fear. But I think regardless, the animal spirits that we're seeing in the economy and the markets, the Fed can't really take the foot off the brake yet. And I think they're going to be on hold until some liquidity event happens, something cracks in the labor market. It's not there yet, but that's what's hard about positioning in bonds. You need to be patient here, because when that turns, it's going to be hard to put the bond allocation on. If it turns fast, you got to sit, wait. We're getting paid nice income, and just wait until that turns, because you're going to see rates likely drop. And if you're not there yet, it could be a tough point to get there quick enough.
Matt, I'll forgive you for stripping out housing, because I feel like weirder things have happened. CPI minus shampoo and dog food or something like that. So Jay, given the reaction to CPI that we've seen, Do you think it's wise to be buying bonds on those types of sell-offs?
Yeah, so first, I don't think that the bond market dismissed the CPI report, Danny. That was a very big reaction that we had earlier this week on Tuesday to the CPI data. And still the market's expectations of when the Fed begins easing have moved back from where they were just a few weeks ago. But from our perspective, I do agree with some of what Matt has said here. A piece of the outperformance was definitely OER. It diverged from the rental data, and we don't think that should continue over the longer term. And even the chair's super core category did seem to surprise at the upside due to some idiosyncratic reasons. But at the same time, we just don't think that the path toward lower inflation will be as one way as it has been for the past 6 months. But either way, we're in between the end of the Fed tightening cycle, and we think just a few months away from when the Fed begins easing. And when it does start easing, it's going to move policy rates significantly less restrictive than they are right now. So that's the sort of period that's been very supportive of being long fixed income, whether it's a very shallow easing cycle like we saw in 1995 or even 2019, much less a full-blown easing cycle like 2001 or 2007-8. So from our perspective, this is the time when you're supposed to be overweight duration as you head into a Fed easing period. But you also need to be very careful, because I think what Matt said is important here. Investors have been positioned for rates to fall, and when positioning really gets aggressively long relative to where it's been over the past year, it can really sow the own seeds of its own destruction. And I think we've seen some of that over the last couple of weeks, because both active bond fund managers and hedge funds were very long heading into the data the last few weeks. It seems to us that it's pretty much more neutral right now, but we're cognizant of that dynamic as well.
That's the positioning on the bond side of things. Matt, do you worry about positioning on the stock side of things? If we're saying that, okay, yields did have a big reaction, stocks reaction down 1 1/3. We basically have already undone that with yesterday's move of 1%. Are we overstretched in this equity market, Matt?
Yes. As simple as that. Keep it simple, right? I would totally say we are. And really what we're seeing is a lot of systematic, algorithmic trading, more trend following type strategies are dominating this market. You can see the fingerprints of it all over the place. And one of the things that we struggle with is now those are all in, max long kind of type positioning, and that can turn fast. And they're bidding up things that don't necessarily have a lot of intrinsic value. Some of the AI stuff does have growth. I get it. But when you're talking about 10% a day type moves, or we're already, into the second month and a half into the year, and we're talking about 50% moves on certain stocks, we think they're going to have to take a breather and likely have to have some corrective price action. So we are looking at cheaper parts of the market. We are looking at less momentum-driven parts of the market. It's difficult for fundamental investors right now because it's so momentum-driven, but we would trim into the momentum factor and find other parts of the world or the markets to deploy that capital.
Right. You'd be surprised that there are other parts of this market right now, Matt, given every day all we're talking about is NVIDIA making new highs. Jay, it's not just a frenzy around AI. This corporate bond market has had a frenzy around it. The demand is insatiable. Yields are quite compressed. Spreads are really compressed. You have companies coming into market even after all of that CPI. Does that say something about fixed income demand? Should the bears be looking in that and say people want paper, people want income, there is still strong demand in this market?
I think it absolutely does, Danny. I think credit spreads are sitting very close to their tightest levels of the cycle. But more broadly, against the backdrop of what's been very strong issuance this year, this reflects very underlying strong demand for fixed income. And even though yields are considerably off the peak we saw late last year, they're still close to the highest levels we've seen in 15, 16 years. And fixed income more broadly is a very viable investment alternative for the first time since then. And while our outlook on credit spreads from my colleagues in credit research is that there's some near-term risk of widening and that you're unlikely to get further spread compression, the supply dynamics, the demand dynamics are all very favorable, and you're likely to earn, as Matt talked about before, pretty strong income in credit and in fixed income overall this year. So I think this is emblematic of that demand without a doubt.
Jay, Matt, stick with us. We have a lot more to discuss. That's Jay Barry and Matt Miskin. Now, let's get a look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle.
Well, Danny, we do have some of the crypto stocks moving higher. In particular, Coinbase, that crypto exchange, it is up pretty nicely at this point with Bitcoin, but also the expectation of a return to profitability when they report tonight, up 4.6%. AppLovin up in a huge way, up 21%. Now, there is a 10% short interest here, so it could be a squeeze, but they did beat adjusted earnings in a big way. They beat sales. The mobile app marketing company, our analysts are upbeat on it, so that is a big winner at this point here in the pre-market. To the downside, though, Twilio down 11.6%. The software company put up a big beat, but the current quarter revenue is surprisingly light. It is up about 70% from last fall, so investors wanted perfection. They simply didn't get it, Danny.
Abigail, thank you very much. Investors demanding a lot this earnings season. Now, coming up, speaking of which, Cisco is joining the growing list of tech companies that are cutting jobs.
Cisco's the backbone of the internet, as you know, and their routers, network, server, business, these things, their switches are truly important to bringing in cash flow, but the future is in services.
We take a look at results from the world's largest network equipment maker and how it may impact NVIDIA's earnings next week. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We look at the free cash flow, we look at the strategy. I want to point out a very underpriced component is the capability they have in these AI collaborations. They're expecting about $1 billion of revenue. It's a small amount of revenue relative to the whole size of the company. There's huge upside to some of those collaborations with NVIDIA, with AMD, with Intel, some of the major players.
The Bahnsen Group making the bull case for Cisco following disappointing results. The company slashed its outlook, announced plans as well to eliminate roughly 4,000 jobs. CEO Chuck Robbins saying this, quote, "We're seeing a greater degree of caution and scrutiny of deals given the high level of uncertainty, making us more cautious with our own forecast." Not a great omen for the market's biggest darling, NVIDIA, whose monster rally will be tested next week when it reports its own earnings. Joining us now is Bloomberg's Mandeep Singh and Ed Ludlow. Ed, let's start with you on Cisco. 4,000 of job cuts. It's yet again another tech company and another round of layoffs.
Yeah, and a big picture macro concern. So 4,000 jobs is about 5% of the 85,000 employees Cisco has. I think, honestly, what's got the street worried is the revision to their full-year sales outlook. So they're saying now that sales would be $51.5 to $52.5 billion. They'd previously guided to $53.8 to $55 billion. So it's a significant revision for the full year. And in the fiscal third, it kind of manifests itself in the short term as well, saying revenue of 12.1 to 12.3, they had seen more than 13 billion. It was an interesting clip you just played. I mean, you have to differentiate the investment that is going on in infrastructure. In other words, the hyperscalers who are building out data center with high-performance GPUs or AI accelerators that go into it. Those things do need Ethernet and other server design components, but Cisco's mainstay is networking. And a lot of emphasis gets put on the collaboration with NVIDIA to try and tap this broader market for AI. But Cisco's kind of target audience is the SME. It's not the hyperscalers where a lot of the money's going right now. You see names like Supermicro, for example, on an absolute tear because their business is more directly relevant to the build out of that data center infrastructure than Cisco. And at the same time, Cisco's trying to be a software name too. So it's a difficult position they're in, but they are vulnerable to the macro picture because of the scale or spectrum that they have within the size of their customer base.
I mean, Supermicro up some 200% this year. Truly bananas. Mandeep, then does NVIDIA fit in the category of not being susceptible to the macro picture like that of Cisco? Can anything stop this stock as it takes over Amazon in terms of market cap?
I mean, the stock versus fundamentals probably are different at this time. I think there is a lot of excitement around how far the stock can run, and that's reflected in the valuation. But look, it's well supported by fundamentals, and there are very few times when you see, a company actually putting out great numbers quarter after quarter, and it could very well be the case this quarter too, because look, the demand is insatiable when it comes to their GPUs, and you know how the dollars are flowing. It's from the capex of hyperscalers that Ed was alluding to, and there just seems to be, quarter after quarter where they have the pricing power. It shows up in their margins, and I wouldn't be surprised if they do something similar here. But again, look, valuations are rich at this point of time, and can they do it, for the next 5 years? I think time will tell, but the demand visibility is there for NVIDIA.
As an investor told me today, the routine is to wake up and check NVIDIA's price. That's all you need to do if you're a stock investor, apparently. Mandeep Singh and Ed Ludlow, thanks so much for that wrap-up on tech. Now, John Hancock's Matt Miskin is turning away from some of these AI names, writing, "We would look to trim small caps, crypto-related stocks, even AI darlings, the momentum factor, etc., after recent strength, and focus on the quality factor." Matt and Jay Barry are back with us now. Matt, you had mentioned this before the break, this idea if you want to trim back on some AI, but if you look at NVIDIA's gains, you look at Supermicro, 200% gain. Can you really afford to miss out on that?
I think the way you put it is a great sentiment indicator. Truly bananas, Danny, was the way to put it, and I like that. I get it. They are going up. I agree with the analyst just said that the fundamentals are pretty good. There is growth. I see that. The margins are good, but it's in the price. And look, it's been a tremendous run. You look at the revenues relative to Amazon, I mean, they're not even close. And to say that the stock is worth that much, I think you got to build on. You've already had huge growth, and now you got to do that again on top of that. I think that's really hard. Right now we look at this part of the market as there's better quality. We're trying to do quality at a reasonable price. That is kind of our mantra right now within the equity market. And unfortunately, they are quality, but no longer a reasonable price to us.
Yeah, fair enough. I was going to say the momentum factor and quality factor do seem to be more closely tied than they ever have been. Jay, if you think about Cisco cutting 4,000 jobs, you think about tech as a whole, I think the tally last week was 32,000 job cuts planned for 2024. And then I go back to the jobless claims we got this morning. It's not showing up on the macro level. If you look at tech, is it idiosyncratic, or do you expect some of these cracks to broaden out?
So, Danny, we are not looking for cracks, but generally speaking, a significant slowing in demand for labor and hiring. And I think you're right. Jobless claims, they're the best momentum indicator that we have for the U.S. economy and still indicate that separations are pretty low and that the labor market's very healthy. But I think if we decompose the growth of the labor market the last few years into changes in unemployment, changes in participation, and changes in labor supply, the unemployment rate's obviously fallen back to multi-decade lows. Participation rates are back kind of at their best levels of this century, and immigration and labor supply is probably set to slow once again. So if that's the case, against the backdrop of what we seem to be seeing is a full rebalancing back towards services in the last few years, it indicates to us that jobs are slowing, but not probably completely cracking. And again, I think this is why we are in the soft landing camp, looking for sub-trend growth, but not necessarily a deep recession, because it's hard to identify really where a nonlinearity comes from in this respect.
Jay, Matt, really appreciate your time this morning. Great to get your thoughts. We're going to have to leave it there. That's Matt Miskin and Jay Barry. Coming up, your morning calls, and later, from big tech to the small caps, RBC's Amy Wu Silverman joins us at the opening bell. We're going to get her outlook on this equity market as the gains, they keep coming. That conversation shortly to come. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the your morning call as a look at some of the analyst recommendations on Wall Street this morning. First up, Morgan Stanley downgrades U.S. steel to equal weight, seeing limited upside due to softening demand and weakening steel prices. Next up, Redbird Atlantic downgraded Comcast to neutral. They expect more downside to cable broadband subscription estimates. Finally, JP Morgan, an upgrade to Coinbase. They go to neutral, pointing to the monster rally in Bitcoin prices this past month. It's a rally for risk everywhere. U.S. equities above 5,000 again for the S&P. Can it stay above there? How many more gains do we get after a weaker than expected retail sales data? Coming up, we're going to speak with RBC's Amy Wu Silverman. She'll unveil her outlook for the AI darlings. NVIDIA gearing up for earnings next week. We'll have that conversation coming up next here on Bloomberg.
life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Equity markets running out of steam as we head into this open. It had been a Teflon market, a gain of more than 1% yesterday. We initially got fuel thanks to that weaker than expected retail sales data, but it is a still strong jobs market that is limiting us from the most of the gains. You're also seeing small caps. Those are outperforming, up 0.7%. The Russell 2000 has gotten beaten up. Perhaps it's finally time for revival. Meanwhile, looking at your cross-asset picture, we are seeing a bid come into this bond market. Not huge, but we are seeing yields go lower by 0.4%, aided by a recession in the UK that saw yields bid off the back of that. Your euro dollar, that's also a little change. We're at 107.69 this morning. Euro had also gotten beaten up after that CPI report. Crude, meanwhile, little change to slightly higher, up 0.3%. The IEA says the same old thing we've always heard, that demand is slowing, but supply in non-OPEC plus countries is rising. So that's your look as we head into the open. As we're in the open now, and of course, one stock to watch at this open is Cisco. Shares are under pressure. They delivered a disappointing outlook, along with plans to cut thousands of jobs. Bloomberg's Ed Ludlow has more from San Francisco. Ed.
Yeah, good morning, Danny. We are down 4% as we were in pre-market. That puts Cisco on track for its biggest drop since November and trading at its lowest level since the first week of December. The job cuts is the headline, right? So 5% of an 85,000 person workforce is about 4,000 jobs. But the street is very fixated on the revision to its full year sales guide. Full year sales will now be $51.5 to $52.5 billion. Previously, Cisco had said $53.8 to $55 billion. So it's a significant revision. And earlier in the program, we talked about what's happening. Cisco's not yet tangibly seeing the feel-good effect from all of the dollars spent on AI infrastructure, infrastructure being the optimal word. Cisco is the leader in networking, with a much wider range of customers, from very small businesses to some large enterprise customers. They have that recently announced partnership with NVIDIA to try and make AI technology more accessible to businesses of a smaller size. But right now, the focus is the hyperscalers. AWS, Microsoft Azure, Google Cloud Platform, the build out that they're doing in data center. And if you look at the sell side analysis, the macro environment is making Cisco's core customer base more cautious, but they're also just only seeing kind of incremental narrative around AI. So the stock now actually paring a lot of those declines down 2%. Even so, clearly not the momentum that Cisco wanted going into the year.
Nope, you need to be, as you say, one of those hyperscalers or the picks and shovels. Ed, thank you so much. Let's stick with earnings. Deere has slashed its annual profit thanks to lower crop prices and slumping demand for equipment. Abigail Doolittle has more. Abby.
Indeed, Danny, and that is why the stock is down nearly 5%, heading to its worst day since August of last year. Now, first looking back, the quarter that they just reported, it was actually very strong. They beat earnings and sales. They sold more tractors than expected, but falling prices really didn't flow through. As for the full year being cut, it's exactly what you're talking about. Farmers, the demand is a little bit less relative to income weakening for agriculture, plus the crop prices falling. We have a lot of, I would say, deep bear markets for some of the grains, such as corn and wheat, not helping out either. As for analysts, they're relatively supportive. I would say neutral to saying it's a solid quarter, just some missteps here. Investors, though, less so. Since the peak, the all-time high last year, Danny, this stock is now nearly in a bear market, down about 19%.
So close, Abby. Thank you very much. Now let's turn to the media space. Shares of Paramount are moving lower on news that Warren Buffett's Berkshire Hathaway reduced its stake in the company. Simone Foxman has more. Simone, what Buffett buys, we all buy. What he sells, we all sell.
Yeah, and selling here about 30 million shares, reducing its stake by a third. Still owns about 63 million shares. Remember, all of these numbers coming at the end of the fourth quarter. So now owns about a 10.4% stake in the company, down from around 15%. This is a stake Berkshire's held since the first quarter of 2022, has been the largest holder of those Class B shares. Bloomberg Intelligence says this move may signal that Berkshire is simply running out of patience with Paramount Global. It's been the center of a flurry of M&A talks, but is still controlled by National Amusements and Shari Redstone. Meanwhile, the fundamentals continuing to deteriorate, as something BI points out. $3.5 billion in losses on its streaming business in the past 2 years. This may also say something about the outlook of those merger talks. Remember, Byron Trott, who is sort of known as the Berkshire whisperer, has been reported to be involved in helping Redstone potentially dispose of all or parts of Paramount and maybe even National Amusements. This really taking a toll on the bullishness we saw earlier this week. We ultimately get a consensus on where the company is going, maybe on February 28th when we get earnings, but at the moment, shares now down to their lowest since about November.
Simone, really appreciate it. Simone Foxman there on Paramount. Now, those are the moves underneath the surface. Your S&P 500 just opening now up 0.2%. And I've got some good news for you. If you went out and bought one of those caps that say S&P 5000 on it, it might have dipped below it on Tuesday after the CPI, but we have bounced back, almost like it never happened. That sell-off was met with a 1.3% gain. We're back at 5K. It is a Teflon market that feels like it doesn't care about hotter inflation data. Let's now get to Amy Wu Silverman, Managing Director and Equity Derivatives Strategist at RBC Capital Markets. Amy, what do you make of the resiliency of this market?
Yeah, there's been shocking resiliency. And when you look to the options market, when you look to what the sentiment is telling you, especially in mega cap tech, it is overwhelmingly exuberant to the point where, you know, we could really call it historic in names such as NVIDIA, for instance, which has yet to report, but will next week. You know, we're looking at levels that we last saw in May of last year when you recall the stock reported up 24%.
I looked at NVIDIA one-day implied earnings move, some 11%. ARM, to your point, huge demand in calls. Record after record is being set for volume traded. Translate the Greeks for us, the gammas, the deltas. What does it mean practically to have such a large bullish options buildup behind these AI and software names?
I think the single most important takeaway an investor can get from this is that when stocks trade on this momentum and gamma-driven factor, it tends to get more momentum to the positive side. So it's interesting because if you ask me what the options market is paying you to do right now, it's really paying you to sell those calls. They're historically expensive, skew is inverted, but when you look at what happens in the past, when you get these levels of exuberance, it typically triggers more upside. And that's what people are really afraid of. I would tell you that, frankly, investors are very afraid of that right tail right now. We've really repriced the whole options market. People are much more worried about that upside gap currently than they are about that downside gap.
There also does have that FOMO kind of factor come back into this market. You look at just what the sell side is doing. Over the past few days, UBS, Mizuho, Morgan Stanley, Bank of America, Goldman, all hiked their year-end targets for NVIDIA, trying to keep up. Amy, is there a sense that if you've missed out at this point that you're just too late, if that tail risk is so alive and present with us right now?
Yeah, you know, I would tell you what the options market is telling you is that there is still that fear of missing out, which is why we see that call wing bid so much. You know, it's interesting because I have to imagine there are folks who are already long NVIDIA, already long the mega cap tech, and are they hedging the downside? They've obviously had a lot of great gains. The simple answer is no. You don't see this on the downside at all. So, you know, folks who are long are not worried about downside, and folks who are not long enough are really worried about not getting enough of that upside.
That is so incredible that the fear is more upside. The fear is not downside right now. Amy, we were speaking with Matt Miskin earlier in the program, who said, I don't want momentum anymore, that factor. I don't trust it. I want quality. Amy, though, are the two tied right now? Because you think of the big tech names that are gaining, they're companies with really large cash piles at the moment. Are quality and momentum to some degree the same right now?
So I think that's a really, really interesting observation, and I would tell you that I probably tend to agree with that. We've been tracking that through our two baskets, our high-quality basket and our low-quality basket. And when you look at what's in that high-quality basket, what has positive free cash flow, what has positive net income, you know, it's the great balance sheet mega cap tech names. It's your, you know, it's your same crew of Mag 7. And what else is really interesting is, you know, you simply have gotten a flight to safety bid. It used to be your flight to safety bid in a 60-40 portfolio was to go to bonds. Well, unfortunately, that correlation has proved to not be very welcoming in recent years, and there's almost been a flight to safety bid inverse correlation between tech and everything else in the market, which is why you get that Mag 7 and everything else effect.
The other side of that is small caps, which have just been beat up last year. We thought they'd do better this year, but it happens again. They are outperforming. The futures are up 1 1/3%. Amy, you write that your clients are asking when the small cap trade reignites, when breadth widens. I want to know the same. What have you been telling them?
So, you know, we started this kind of brief romance in November where we really saw that breadth widening out, and then that kind of got all sucked away at the beginning of this year. I think for us to turn to that widening breadth argument, you're going to have to see that exuberance and skew in those mega cap names start to wane, because I do think there is sort of a zero-sum situation going right now because the flight to safety really is mega cap tech. If we start to see that wane and we start to see that exuberance go back to the small caps, to IWM as a proxy, for instance, that to me is telling me the market is finally ready for breadth. It wants to be ready for breadth, but you don't actually see it in the options market yet.
I'm ready for breadth, Amy. I'm ready to talk about something different than the Mag 7, let me tell you. Amy, stick around with us. That's Amy Wu Silverman. Now, coming up, House leaders are set to gather for talks with top U.S. intelligence.
Last month, I sent a letter to the White House requesting a meeting with the president to discuss a serious national security issue that is classified. I will press the administration to take appropriate action.
We'll have the details on the potential threat from Russia next. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. the customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range, because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that, I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
I'm not in a position to say anything further from this podium at this time, other than to make the broad point that this administration has gone further and in more creative, more strategic ways dealt with the declassification of intelligence in the national interest of the United States than any administration in history. But in the meantime, the most important thing is we have the opportunity to sit in a classified setting and have the kind of conversation with the House Intelligence leadership that I, in fact, had scheduled before Congressman Turner went out today.
National Security Advisor Jake Sullivan speaking yesterday about a threat to the U.S. identified by U.S. intelligence. Since that threat has been revealed, Russia molds a nuclear weapon in space, although no weapon has yet been deployed. Sullivan will meet with top congressional leaders today to discuss that issue. Now, it also comes as Donald Trump molds plans to push Ukraine to negotiate an end to the war if he returns to the Oval Office, as well as considering scaled-back commitments to some NATO members. Bloomberg's Anne-Marie Hordern has been following it all for us. Anne-Marie, how much of a break would this be, of a fracture would this be within NATO if Trump tries to push something like a two-tiered system ahead?
Well, one thing we should note is that these are just ideas that the campaign seems to be discussing and that we were able to get a little bit more insight on. We do know that Trump, for years, has been talking about NATO and wanting allies to reach this 2% target. Obviously, this has become front and center, where he had during a campaign event, talk about the fact that when a country stood up and said, would you come to our rescue? He said, well, if you didn't hit your 2%, he would say he'd allow Russia to do whatever he want. For some, this was almost going over a red line. You heard from someone who's worked with him in the past, talking about the fact that this is just tough love. But what they would seem to be doing, this two-tiered response, would be that those that did hit their 2% target, their own defense to their own country, to their own defense money, that they would be viable under NATO under Article 5. And then those that didn't potentially would not. Or maybe what the administration would do is something, a tariff approach, maybe like a carrot and stick approach to try to get more of these NATO members to hit 2%. But we should note, these are just ideas within a campaign, and nothing has changed the U.S. force posture with NATO at the moment.
I got to be honest, Anne-Marie, before I went to sleep last night, I saw that ABC story saying that Russia's plans and their threat involve nuclear weapons in space, and then I prompted to not be able to sleep last night. What do we actually know about this?
Well, this caused a lot of confusion because you had a top GOP lawmaker coming out yesterday and saying that the president should declassify some of this information. What we do know is that Jake Sullivan, the president's national security advisor, will be meeting with top Republican and Democratic lawmakers, the Gang of Eight, as they're known, in Washington, D.C. today to discuss this intelligence. And what we do know is that Russia is discussing the possibility of basing a nuclear weapon in space. Is it an immediate threat? No. So, Danny, you can go back to sleep. But what did cause a lot of concern was the fact that there was this time period where no one really knew what this Republican was talking about, and everyone was concerned that this was potentially imminent, but obviously potentially we'll get more details as he will be briefing those lawmakers today.
I know I probably still won't be able to sleep, but thank you for trying anyway. Anne-Marie Horder, thank you so much. Amy Wu Silverman of RBC is back with us. Amy, you write, talking about elections is so cringe. I agree with you, Amy, and I wish we could not talk about it, but we have to, because we are in the middle of the swing of things when it comes to this campaign season. Do you adjust your portfolio? Do you buy hedges? Do you do anything to prepare for any potential outcome, or is that folly?
You know, it's if you look to history, the short answer is you really don't. You know, there tends to be some pop. You actually tend to get rallies into elections, but for the most part, elections are something that happen in cycles, but it doesn't really impact the market all that much. However, we do have to consider the tails, and you know, it has been cringe, I think, for investors to talk about elections. Some have called it staring at the sun. It's just very unappealing. But given that we have this event ahead, I would say the left tail and the right tail right now are actually a Republican or a Democratic sweep. That's what they talk about on the tails. And then obviously the Supreme Court ruling is something that can again throw a mine into the field right now.
Here's something I didn't expect to see. You write that financials have been really well behaved during elections, an 88 positive hit ratio, 88% since 1992. Can that still play out, though, when you have simmering and sometimes boiling in the background concerns about regional banks, about NYCB? Is it the same this time?
So it's really interesting. First, I borrowed that statistic from our equity strategist, Lori Calvasina. So the only time since 1992, she notes, where financials didn't do well, go rally into election, was the great financial crisis. Outside that, it's done well. And to me, it's actually a breadth argument, too, because if you're going to have a widening of breadth in the market, you're going to get that from financials. And three, I would say, while New York Bancorp was obviously down a lot, you actually did not see it in KRE volatility. So in fact, the put option prices for KRE remain near historic lows, even with what happened during NY Bancorp, which to me would argue that folks think the systemic risk is off the table.
The Hong Kong stock index at HSI, Amy, it's down 50% from its 2021 peak. Even if I didn't believe in an economic recovery in China, even if I wasn't worried about some of the macro, the geopolitics, again, related to what we're talking about in this election, can I say I should be buying that because it's just sold off so much? It's got to mean revert at some point.
Yeah, so, you know, look, every time I do my marketing trips to see clients, you know, globally, we talk about the China rebound. And if you'll actually remember, there was a time where the idea of a China rebound, of an Asia rebound, was quite consensus. And then, you know, you kind of get into this, oh, it's uninvestable, what can I do about it? I would say right now the consensus is forming that perhaps we have seen a bottom. You really see that first in the options market. That tends to be the leading indicator, because what people do initially is they just dip their toe in the water. You see that through FXI call buying, through SHR, through KWEB, through these proxy ETFs, essentially saying, you know, I'm kind of worried that if it has bottomed, I really need to be able to jump into that pool. I want to be able to do that quickly. And so again, you see that in the bullish options sentiment, which leads everything else.
I was going to say, you've seen some of those really big lottery ticket kind of bets in KWEB. That's, of course, the ETF tracking the China MSCI index. Volume spiked last week to the highest in a year. Does it make sense to go long those YOLO kind of China bets at this point? And can you not be actually long the cash market itself right now, Amy?
Yeah, I think it do make sense. And this goes back to the earlier comment I made about momentum in general, which is, you know, if you think about what the options market is actually paying you to do, it's, you know, in the case like in NVIDIA, for example, it's to sell that upside because it's so expensive. But if you actually back test it, if you actually look at what happens, momentum begets more momentum. And there's obviously a gamma dynamic to that as well. So essentially, if you're worried about that right tail, which the market has repriced to be much more concerning to that left tail, that is what you do to get one toe in the water before you have to jump into the pool.
Amy, what I'm learning here is don't fight the big mo. You can't fight the momentum. Really great to catch up with you this morning. Amy Wu Silverman, thanks for your time. Let's get now some of the sector price action this morning and head over to Bloomberg's Abigail Doolittle. Abby.
So right now, Danny, we're looking at very interesting sector composition. We have the S&P 500 up about 0.3%, but most sectors are higher. In fact, we have a few sectors, about 5, that are higher by about 1%. Real estate up 2.1%. Its best day of the year on positive earnings reports. Utilities utilities, materials, financials, energy, all up solidly. In fact, healthcare up pretty well too. But to the downside, you have those heavy weighted sectors, tech and communication services, both down. Communication services being dragged down by Google, down about 3% on reports that OpenAI may be creating a search feature. Let's take a look at another sector that is under pressure on the week, underperforming, and that is the S&P 500 retailing index, down 1.6%. The S&P 500 itself down about 0.3%, so really underperforming. This, of course, as we have those those weak retailing numbers come out, but Lowe's, AutoZone, Ulta, those are some of the stocks in there. This index really not doing so well this week, Danny.
Abigail, appreciate it. Thank you very much. Now, coming up, we're going to look at the market-moving events that you need to be watching. That's up next in our trading diary. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Bloomberg. Just about 30 minutes into your trading day, small caps outperform, up by more than 1 1/3%. The Nasdaq down after those Cisco earnings disappoint with 4,000 job cuts. Your S&P little change, but we are back above 5,000. It is a Teflon market, maybe aided by some of the weaker retail sales data. Flip it up, look at bonds. Those are also getting a bid this morning. The bid started when we heard that there was a recession for both the UK and for Japan. You are looking at down about 4 basis points across the curve, belly of the curve 10-year, that outperforms down 4.5. All right, time now for your trading diary. What you need to be watching this week: Fed Governor Chris Waller will be speaking at 1:15 Eastern. Then we're going to be hearing from Atlanta Fed President Raphael Bostic. That happens at 7. Then more earnings will be rolling out. DoorDash, Roku, and Coinbase all report after the close. Friday, San Francisco Fed President Mary Daly will be speaking. And then we're going to get U.S. PPI figures. Will that data, will the Fed speak, shake things up yet again in this resilient market? This was the countdown to the open. This is Bloomberg.
I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, Alex Steele, Paul Sweeney live with you here. Also streaming on YouTube as well, so check us out there. Lots of economic data, lots of earnings data. We'll break it down today. Edward Howerson, Bloomberg team leader, covers FX and rates. He's going to give us the breakdown, kind of what he's seeing in the markets on the back of some of this economic data. Woo Jin Ho from Bloomberg Intelligence will break down the Cisco numbers, a little bit weaker than expected. What does that mean for the tech equipment makers out there? And then, of course, it is Thursday. That means Barry Ritholtz Wealth Management. He's going to join us and pretty much talk about whatever he wants to talk about. But first, let's kick it off with Mr. John Tucker and a Bloomberg Businessman.
All right, let's start off with some data. The import price index up 0.6%, so that's hotter than what we had expected. Right now, the major averages, they are mixed. Treasury yields, we'll start there, they're lower. Wallets collected cobwebs last month. Retail sales broadly declining in January. That follows a strong holiday season, raising question about the durability of consumer spending. The value of retail purchases, unadjusted for inflation, decreasing 0.8%. And now this is could be one of those bad news, good news scenarios on Wall Street, bolstering the case for the Fed to cut interest rates this year. That's why we do have Treasuries, the more policy-reactive 2-year, 3 basis points lower, 4.54. Ben Laidler at eToro agrees risk assets are in something of a melt-up.
This is a real Teflon-coated market, and it's got multiple drivers. Earnings and the economy are both over-delivering, and an awful lot of investors have still been shut out of this market and have been forced to sort of play catch-up.
Sorry, Tom clumped on him. S&P 500, 9 points higher. That's up 0.2%. We're 5,010. Dow Jones Industrial Average up 179 points. The NASDAQ 100, 49 points lower. and that is down 0.2%. We're brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit ibkr.com. The story I've been waiting for, I don't know what kept them so long, Wawa aiming to open
big.
Wawa.
as many as 280 new stores over the next decade. This is a push for the rest of the country. Wawa right now, as we well know, is something of a cult along the East Coast of the United States.
All right, my Wawa story is Princeton, New Jersey. It was by the train station. Princeton has a little station. The train takes you from Princeton to Princeton Junction, where you hook up with the Northeast Corridor line. The train actually is called the Dinky because it's just one car. Anyway, the Wawas are institution for decades of Princeton University students. They moved the train station, they upgraded the train station, and they weren't going to include the Wawa. The town came to a screeching halt and said,
nuts.
no, you will not build this train station unless you build us like the world's best Wawa, which they did, and now everybody's happy.
I didn't know anything about Wawa until I went to school in the Midwest. And then the Wawa was there.
The Wawa is in the Midwest.
Yeah.
Okay.
The Wood family, Graham Wood
I
specifically,
didn't know
back
it was
in 1964.
Here we go.
opened
Here it is.
Yep.
No, it was the family. He wanted to in Wawa, Pennsylvania. That's where it gets its name from, and he wanted to sell extra milk that he had from his dairy farm. That's how they opened. The Wood family
Obviously.
they are worth $6 billion
Yes.
today.
And it's privately held, right, Jen?
Correct.
Oh, man.
Okay,
There's so
to be
many
fair,
great-
he had time to prep that. So
he did.
let's see how he does the rest of the couple
You don't think
hours.
I just pulled that right out of
100% feel like that's on
my
your screen right
useless
now.
brain of knowledge?
So again, the highlight here is other parts of the country. I think in the South now are going to get to benefit from the Wawa in their local community, and that is a good thing. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We've kind of got a mixed tape out there, a little red, a little green. We had the economic data coming out. Retail sales a little bit weaker than expected. Is it a blip or is it a trend? I don't know.
I mean, yeah.
We'll hear from the retailers when they
report, and then their guidance now I think will be all the more important. I am really interested in like the lack of reaction I feel in a negative way to the market. So then it's going to be as bad news, good news, that whole scenario, which can get a little tired out. But this also just brings me to the point that we must follow the Alex Steele indicator. So if I'm on a budget, we must acknowledge that, and retail sales will go down, and that will be bad for some retailers. Where I'm buying is not where you want to be buying in terms of the equity market because I only shop on sale. This just reinforces this view of me.
You only shop on sale.
Only shop on sale, and I'm on a tight budget, and I did not
don't
spend in
believe any of
January.
this.
This is 100% true. I'm going to have my husband call in, and we can have this conversation.
Well, I think you're the leader of that
true.
household and those kinds of decisions. Abigail Doodle joins us here on this market, kind of red and green on the tape here. Abigail, she covers all the markets for Bloomberg. Abigail, what's jumping out at you, some of the trading you've seen today and maybe over the last few days?
Right now, mixed markets here. The NASDAQ 100 down 0.3%. The S&P 500 trying to hang on to a small gain. And then you have the Russell 2000, which got pounded on Tuesday, down 4% that day. Its worst day in, since July of 2022. Trying to rebound again, up 1.2%. I'm also taking a look at yields. It was interesting when those weak retail sales came out. Stocks not really affected all that much, but yields were. Yields instantly came in a bit. So bad news was not great news for stocks, and put a little bit of a haven bid in some ways, with stocks not reacting to the upside in yields.
I think part of that, though, is the economic data everywhere else really stinks. So Japan in a recession, that's pretty terrible. The European Commission came out and talked about Europe growth, not great. UK in a recession. So on a comparative level, I mean, the U.S. is still going to be the best growth, the safe haven. You get a blip, but it's still a strong economy. I feel like that's where the broader economic
maybe, but I don't know.
takeaway.
There was the yields plunged on that data coming out. So.
Okay.
I mean, they came in 5-6 bips right away, where stocks really did nothing. So you typically in this environment, with investors depending so much on the Fed and what's ahead for the Fed, you typically see a relationship that makes more sense in terms of yields go down, more liquidity, stocks go up, or if yields go higher, less liquidity, stocks go down. And we're not really seeing that outside of a mixed basis. I think the other big question is that gap we've been talking about over the last couple of days for the major indexes, including the S&P 500. Is it going to fill? And actually, that question, was it answered just briefly on No, so it's still open by a hair.
So we can't trust the rally? Is that the idea?
Well, that actually, I need to take a closer look at this chart. It's hard to know right now. It's hard to know right now. If the pause, we should know tomorrow. Tomorrow we will likely either see a solid move to the downside, or we're just going to see the gap fill. The gap could still fill today, and then we'll still see the move to the downside. But the question is, we had that severe selling on Tuesday. Everybody taking off sides. So the last couple of days, people have been trying to recalibrate, figure things out, bring in this retail sales number, the rest of the world, the economic data that you've been talking about, and the idea that the U.S. is the best block. But is it the best block or the best house on a bad block? But you still want to be in that house anyway. And there's a pause. There's going to probably be a pretty, just based on the charts, there's probably going to be a pretty solid move to the upside. Now, speaking of charts, this is the power of technical analysis. So basically what you're looking at is you're trying to figure out whether the buyers or the sellers are in control. Typically, there are smart early investors that have information that the rest of us don't have. And the reason I'm bringing this up is Apple. You are very smart, and smart. As we all are. Alex, John, they were all smart. But the folks at Warren Buffett's Berkshire Hathaway, they were selling Apple last year. Apple down this year, underperforming in a big way. That chart has been rolling over for a while, and when you have a big investor that's unloading, they don't want to do it in a way that alerts the market to it before they get their profit. I mean, they have a big profit because they took their position on. But this year's selling, the reason that Apple is down on the year right now, down 1.1%, hugging the 200-day moving average. On a monthly basis, the RSI coming down, not really great. On the year, let's see how much that stock is in fact down 5%. So not a huge loss, but in contrast to the S&P 500, which is higher, that's the power of technical analysis, that all the players in there on a big name like that, and that obviously is a whale type player, so it's showing up a little bit more. But so for the S&P 500 strongly right now, looks like there could be a significant move, probably more sort of the downside than the upside.
Can I call out a fun name today? Shake Shack.
Shake Shack.
Some good number stocks up.
I finally ate there over the last year for the first time.
And?
It wasn't, Alex, it wasn't what everybody said.
Anyway, right?
Burgers?
Oh, you are? Okay, okay. So here's my recommendation for Shake Shack, because I do this with my daughter all the time. She works down there. In the nice weather, go to the one in Madison Park, down on Madison Avenue,
nice.
24th Street. They have a nice Shake Shack there. They have nice tables. There's lots of shade, lots of kids running around, lots of dogs running around. It's a nice experience. I recommend that to my friends that are coming in, tourists. If it's warm weather, go down and get a burger with the kids down to Shake Shack in Madison Park down there. Anyway, good quarter stock up 20%.
But is it worth the calories?
Sure. I mean, you're not doing it every day.
Yeah, all right, fair point.
So this is an interesting, so they beat by 460%, but what they were expected to put up just a fraction above a penny, they put up 2 cents, so that's the beat. The other thing to think about here, they did beat sales, to be fair, 2.2% better, $286.24 million. There's a 9% short interest on this stock, so this is a bit of a squeeze.
But I'm looking at all these, I don't know what you call them. It's not fast food. There's a term for it. Shake Shack, the Chipotles of the world.
They're all like healthy fast food or something
like that. Mike Halen's got a term for it. But over the trailing 12 months, they're all up 50 to 60%. So it's been a nice play there. All right, Abigail, thanks so much for joining us. Abigail Doolittle with the latest on these markets. Again, lots of U.S. economic data out. We had the retail sales today. Let's break it down a little bit, see how the market's reacting. Edward Howerson joins us. He's Bloomberg team leader in the Americas, covering the FX and rates. I think he's down in D.C. or something like that. Anyway, he joins us here via Zoom. Ed, what are you making? What are the markets making? What's your interpretation of some of the economic data we've been seeing here? We had jobless claims. We had retail sales. What do you make?
Yeah, Paul, by the way, I'm just thinking about Shake Shack now.
Yeah, you get a good lunch
data. But,
do you like the Shake Shack? I think more importantly, Edward?
Yeah, I think that it's representative of how people are thinking. Is that we saw a slight beat in terms of jobless claims. We saw retail sales better than expected, even though they were, or actually they were worse than expected. Yeah. But perhaps there was some seasonality, some weather involved in that, and we round tripped in terms of the reaction from the market since CPI. We're back, relatively speaking, to where we were pre-CPI on the Treasury yields. And that is slightly higher than the 4% anchor that we had around the 10-year mark. We're sort of into a new trading range. And markets are trying to see, is it 3 cuts this year? Is it 4? Is it 5? They're getting closer to the Fed, but they're not quite where the Fed is, which is at 3.
So if you were to categorize this and the data that we got, is this still a Goldilocks economy, or is this a significantly weaker economy?
I think that we're in the Goldilocks phase to potentially overheating is so if we went in any direction, the direction that we could go is towards fewer cuts. The economy too strong, and I think the jobless claims number that we saw today is indicative of the directionality. We're moving past 100-day, 200-day moving averages in terms of bond yields. That means that they're going up, and they're going up because the economy is strong, and potentially the Fed is not going to cut as much. And you add in the last CPI data that we got, and that makes it seem as if we could almost be too strong to get the kind of rate relief that people have been looking for.
Ed, we had a guest on earlier this morning on surveillance who said, if you're doing scenario analysis in your portfolio, you can't rule out a rate hike in 2024. Do you hear that in the marketplace at all when you talk to your sources?
Yeah, we were just talking about this on a team call. And I think that, number one, I would say that the data that came out today largely shuts that down to a degree. If you look at, say, Fed funds futures, we're looking at maybe 10% of the futures betting for staying pat, 1 or 2 hikes, and the majority of the actions in the 3, 4, 5 rate cut camp. However, we've seen notes out from Wall Street analysts talking about, especially because of the economic surprises being to the upside, that perhaps it's not just going between a standing pat and cutting, but now what I would call two-way risk. The risk that actually it's not just cutting and how much cutting, but potentially that they could hike. But that's very much a tail risk scenario at this point. And I think that the data that we got today sort of takes that tail risk a bit off the radar. We'd have to see more negative data, particularly on the inflation front.
Are you surprised about the market reaction today off the news?
I'm not, because I think that you could call it a shot across the bow in terms of this tail risk scenario that we were just talking about on the CPI data that we saw. But we're at levels in the market where people want to buy. So if you're getting a 10-year at 420, 430, that's a very good level. Same thing for the 2s and the 5s. So people want to buy Treasury bonds at these levels. And so when we saw the data, the fact that the Treasury market rallied makes a lot of sense.
What's the next data point that your team, and I guess the Federal Reserve is probably going to be looking at here prior to the March meeting?
Yeah, PCE, that's really what it boils down to at this point. I think it was Austin Goolsbee. He was talking to Mike McKee earlier in the week on Monday, and he was saying that, we're looking at PCE. Jay Powell, when he was talking to 60 Minutes, he was talking about, 6 months, and we want to see more data. So we're looking sort of at the PCE, core, super core services in particular, and we're looking at those numbers on a rolling 6-month basis to be able to give the Fed the confidence that it has that inflation is going to continue to come down. We were at like 1.9% for the last read for the last 6 months. And so the next read needs to be in that range for us to think, okay, May is still on the table. And then June, it seems like a very good bet for the first rate cut. But if those numbers back up in any way, then suddenly, exactly what we were talking about in terms of the two-way risk, it starts to come back into play. People start to think, wait a minute, inflation's sticky, and the Fed's not going to cut. Maybe they could even hike.
Edward, always good to talk to you. It's been too long. Edward Harrison, Bloomberg team leader, Americas for FX and rates. We also didn't talk about housing. Sentiment, did you see the sentiment among U.S. home builders rising to a 6-month high in February? Lower mortgage rates, it is amazing.
Yes.
Rates go down a little and the demand ticks up a lot.
Yeah.
Like there's clearly the desire and the engagement to buy at a lower mortgage rate. And that hurdle's not that far.
Yeah, I know. I think when we get below, assuming in the back half that we get below 6%, that'll be interesting.
Oh yeah.
For people.
Those brokers are gonna be super pumped to refinance.
Yep, absolutely. And I'm looking to refinance, so if anybody wants to give me a good quote, you know where to find me. This is Bloomberg.
headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, in the Bloomberg News with this Bloomberg Business Flash. Major stock averages, right now they are, they are mixed. 9 of the 11 major industry groups in the S&P 500 higher. Real estate, the best performer, Information technology, the worst performing group, and that's where you're going to find shares of Cisco. They slashed their full year forecast. Maker of computer networking equipment, also cutting about 5% of the global workforce. Cisco also weighing on the NASDAQ 100, keeping a lid on further gains in the Dow. It's a bellwether for the ag industry. Deere and Company shares, they're falling. The world's biggest farm machinery producer trimming its profit outlook for this year. Farmers getting less for their crops. They have less to spend. S&P 500 right now up 10 points. That's a rise of 0.2%. We're at 5,011 on the index. The Dow Jones Industrial Average up 206 points. That's a rise of 0.5%. The NASDAQ 133 points lower. That is down 0.2%. After the data today, the 2-year yield 3 basis points lower at 4.54. The 10-year 4 basis points lower. That's at 4.20. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. We're going to talk about Cisco. Do you have a cool tidbit thing? Did you?
Just remember, this is
something?
Cisco with a C, not Cisco with an S, the food services and distribution company whose trucks are always ahead of me in the Lincoln Tunnel, slowing my commute.
That Cisco is also quite interesting. They have a huge business model. It's enormous. It's like a company I want to get in there and figure out what's going on.
So if you like a particular restaurant and see a Cisco with an S truck parked out front, they have the food services company. Does that mean the food
Napkins,
is...
tablecloths, all the things.
But also like prepared foods, don't they?
But I think their real business is like tables and silverware and the stuff, the guts.
Okay.
See? We got something there. Let's go to Cisco though, the one with the C.
Wasn't much.
That stock down about 2%. It's off its lows though. Let's bring in Woo-Jin Ho. He's Bloomberg Intelligence Senior Technology Analyst to break it all down. Woo-Jin, did anything really surprise you with Cisco? Like in some ways, we knew the environment was going to be soft. We knew they were going to have to integrate a takeover, and that was going to have some churn. What was a big standout?
Well, I think you're right there, Alex. I think after the job loss leak or job cuts leak from last quarter, I think there were expectations that there were going to be cuts to estimates. Quite frankly, the big standout for me was that the cuts weren't big enough. 5% OPEX cuts, that's par for the course for what Cisco typically does. But at the end of the day, I mean, given the stock reaction based on reports, it looks like there were a lot of this was expected.
You know, Woj, I've followed the Cisco name for decades. I mean, it's one of the founding Silicon Valley tech names, based in San Jose, right smack in the middle of Silicon Valley. What are they not getting right here? The stock hasn't worked for a long time, and from your perspective, what are they just missing here?
Well, let's talk about large cap stocks in general, right? If we think about the big bangs, right, or let's say Microsoft, the old tech guard, Microsoft, Google, right? They all really led on a cloud software transition. If we think about it from the hardware old guard, Cisco, Dell, HPE, or the old HP, they're still relatively a hardware business. So you're not going to get the fast, sexy growth from the hardware business. I mean, if you look at Cisco, after the estimate cuts, $52 billion for fiscal 24, that brings them back to 2024 levels, right? So you're not getting the growth that people want, and also you're not getting the margin profiles that you want as well. So that's why the multiples are lower and the growth is shallower.
So has the stock then re-rated for that? I mean, from what we say, we kind of knew that was coming. So are we at a right level, right valuation for it?
Yeah, so if I look at the historical valuation for Cisco, it's trading around 13 times right now. Cisco typically trades roughly around 15 to 17 times. So it was priced to be cut, right? Now the question is what does this pending Splunk deal do, and does that help reinvigorate growth? Now, what I will say is that consensus estimates probably won't bake in the Splunk deal, which adds about another 8% on sales, neutral to earnings near term, but it could spark earnings growth if they start bringing OPEX or operating margins for Splunk more in line to where Cisco is today.
So you know, it's Alex. I mean, over the last 5 years, I'm using the comp function, COMP, which is one of Matt Miller's favorite functions. So over the last 5 years, this stock has compounded 3% per year. Cisco, S&P 500, 14.5%. The S&P information technology sector, 26%. So it's really, really underperformed. Going forward, Wooj, I guess over the next several quarters, what's Cisco saying about their customers and inventory, and you know, what are they? I mean, cutting this forecast suggests that they don't have a lot of great visibility here.
Yeah. So if you remember the server and storage cycle from a year ago, Cisco is going through that right now. Part of it is because of the supply chain glut. All of a sudden, their customers got their equipment 2 quarters ago, and they're taking their time implementing it. So, you know, typical cycles are roughly 5 to 6 quarters. I was running through the numbers, and we're talking about 30%, anywhere between 27 to 30% declines for the next 2 to 3 quarters for Cisco, and they're probably not going to get out of it and return to growth until. I'm sorry, for the networking business, not sales, for the networking business. But I don't think they won't get out of this decline until the second half of fiscal year, which is about a year from now, right? So, you know, again, the model's going to be reworked primarily because of the Splunk deal. And the hope is that they're going to have more recurring revenues to boost up the multiples going forward.
Right. So subscriptions, basically, rather than just here's your bit of hardware, see you guys later. Where's the AI component for Cisco?
I will tell you, they're making a lot of good progress. And they had $1 billion in bookings. And backlog orders with cloud customers, and the issue is that only represents 2% of total orders, right? So it's still relatively small. It is going to be growing, and they're probably going to bang the drum louder to the on the AI theme over the next couple of quarters as these deals really start to balloon. The one thing is, again, it's still a corporate IT name. If I were to pick one AI name on the networking side, it's probably going to be more Arista than Cisco for now.
So again, is there a way, Wooj, just broadly defined on the hardware side? Have investors embraced any of the hardware names as AI plays? Is it, because it just doesn't feel like it. It feels like what I'm hearing from, you know, a lot of your folks on the tech team at Bloomberg Intelligence, it's kind of software, applications, that kind of thing.
Yeah, so I can name 4.
Yep.
Right? Arista Networks, right? If you look at that stock, that's been up 88%.
Wow.
Supermicro, that's been up 846% over the past year, right? And Dell, that's been up 10%. And they reported in a couple of weeks. There's a growing AI story there. And one name that's been underappreciated is probably HPE. They have a supercomputing business, high performance computing business, but the story is a little muddled because of a pending Juniper deal. And then there's you know, my colleague Steve Zhang, he covers the white box vendors, and there's some white box vendors that may potentially benefit from because they sell server equipment to the cloud guys.
So you were saying that the AI stuff growing about 2% a year kind of thing. Is that considered good? When you obviously compare it to a different kind of company like NVIDIA, it's not. But for Cisco in this area, would that be good?
It's 2% of total sales,
okay.
Right? I suspect that sales rate could potentially grow well into the double digits over the next couple of years. They are one of the ARM suppliers for AI. And you've had me on the show before. We've had this conversation, a technology conversation between Ethernet and InfiniBand. You're going to start seeing this burgeoning shift from NVIDIA's InfiniBand technology to an open standard called Ethernet, and that's where Cisco is going to benefit over the next several years.
Okay, so short term, what's next? Like, what are you most interested in? Is it going to be the Splunk acquisition and getting that done, and how that's going to be merged?
Exactly. I mean, look, it's probably, well, first of all, I think that earnings cuts may have bottomed.
Okay.
Right, earnings are bottomed from here. The next thing I need to do is fold in the Splunk estimates once they announce that deal, and then and just keep track of where IT spending is relative to Cisco, as well as keep track of where the AI story goes. Right, they had a couple of nice announcements. We just need more and start to see it in the numbers in fiscal 25.
All right, Wooj, thanks a lot. Really appreciate it. Woo Jin Ho joining us from Bloomberg Intelligence. He is a senior technology analyst at Cisco stock, down by about 2%. Overall, market's holding up okay. The S&P is up just 0.1%. We're over that 5,000 level, but reversing the losses that we saw on Tuesday is going to be a tough call. Real estate, materials, utilities, all outperforming in the S&P, so kind of a mixed bag when it comes to risk on versus safety trade. There is a bid into the bond market, but not surprising when growth was really not great over in Japan, the UK, and the Europe outlook as well. But for now, we want to go over to Michael Barr for national and world news. Michael.
Thank you very much, Alex. Paul, John, a judge in New York ruled jury selection in Donald Trump's trial over alleged hush money payments to a porn star will start as planned on March 25th. Trump appeared in the packed Manhattan courtroom this morning. Lawyers for Trump had argued for a delay until after the November election. Meanwhile, there is also a hearing today in Georgia where a judge will consider a motion to disqualify the district attorney in Trump's 2020 election interference case. Police in Kansas City are trying to find a motive for yesterday's shooting at the Chiefs' Super Bowl celebration parade. One woman was killed and 21 others were wounded, including 8 children. Police say 3 people were taken into custody and firearms were recovered. Eyewitness Trey Filter helped to take down one of the suspected shooters, holding the man down until police arrived.
They started yelling that there's a gun. So we were pretty steadfast in holding him down there and, just trying to take care of our butts there.
Trey Filter spoke on ABC's Good Morning America. President Joe Biden now calling on House Republicans to vote on the $95 billion aid package for Ukraine and Israel, warning that refusal to take up the bill passed by the Senate this week would be playing into Putin's hands. NATO Chief Jens Stoltenberg expressed confidence that Congress will pass the bill.
I expect the U.S. To be able to make a decision that the Congress and the House of Representatives will agree continued support to Ukraine, because if we allow President Putin to win, it will not only be bad for the Ukrainians, a tragedy for the Ukrainians, but it will also be dangerous for us.
Stoltenberg spoke in Brussels today. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with Treasury yields. We have the policy reactive 2-year, 2 basis points lower, 4.55. The 10-year, the benchmark, down 3 basis points. That's at 4.22. Lower after the latest data, slowdown in retail sales, kind of boosting the case for the Fed to maybe cut interest rates in the second quarter. As for risk assets, the major stock averages, they are mixed right now. Meantime, Philip Tays at Tays Corporation says, you know what? Investors need to think about an interest rate hike from the Federal Reserve.
It's been perpetual that we think the Fed is going to be more dovish than they have been, and it persists today. And so the thing that I think people are not fully contemplating is the possibility that there's not only no Fed cutting, but that it's parked or it moves higher.
But then you have the Fed swaps. They fully price in a rate reduction in June. NVIDIA retreating from an all-time high. Cisco Systems sinking on plans to cut thousands of jobs. They saw a slowdown in corporate tech spending, wiping out its sales growth. S&P 500 up 7 points right now. That's a rise of 0.2%. We're at 5,008 on the index. The Dow Jones Industrial Average up 162 points. NASDAQ 100, 42 points lower. That's down 0.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Thank you, John Tucker. Yeah. I turned on his thing at the same time, so...
You're trying to trick me.
Yes. This is my sole goal in life. You were just realizing this at this moment?
You're having fun with this.
Yes, we are.
At my expense.
Who wants to bring in Barry Ritholtz?
Who's that guy?
Yeah.
What guy?
I don't know. I mean, he wanders around here once in a while. Why he doesn't come into the studio when he's here?
Because he's got a job.
Oh, he does. All right. Barry Ritholtz. Barry Ritholtz apparently has a job, and I think that's because he runs his own, investment management firm. It's not just the host of Masters in Business, which is a great, great podcast. And I know he's got other podcasts, which he's free to talk about. Barry, I just want to go to a part of the business I'd love to get your opinion on, because we finally had the Big Take folks write a nice article yesterday on commercial real estate and, like office space and big markets. And boy, we're seeing some big markdowns. How is this going to really manifest itself for investors, do you think, over the coming years?
So, a lot of people are trying to compare this to 08, 09, which there's such a fundamental difference. 08, 09 was when it finally cracked, it was primarily precipitated by the 228 mortgages that after 2 years, the ones that had been written in 05, 06, 07, maybe even before, when they reset after the Fed raised prices, suddenly there was a huge wave of defaults, and that was it. That was the straw that broke the camel's back. You don't really get that here, because most of the commercial leases that are discussed in the big piece was in the Big Take are 10 and 20-year leases. And so 5 or 10% come up every year. Clearly, we're nowhere near full occupancy. Vacancy rates are up. And physical, Castle does the card swipe measures. It's real-time data of how many employees swiped through the security system in. So you could tell, hey, we're 58.7% on a rainy Monday. They know it that precisely. So we're going through this very painful reset, this shift, as hybrid and work from home just becomes part of the landscape. Now, some bigger companies, Goldman Sachs, JP Morgan, even Bloomberg, can say, you have to be in 4 days, you have to be in 5 days, whatever they say goes. But a lot of smaller companies kind of use that as a recruiting tool to say, hey, we only require 2 days, or we're full hybrid. Come in when you want. Once a month, we need you in. And it gives them a recruiting advantage. But there's no doubt the office structure has changed, and that's showing up in the quality and the value of these commercial buildings.
So I guess my question becomes, what happens to these things? Like, does someone come in and buy all this stuff? Is the bank wind up owning things? I'm trying to understand like what the ramifications of this will be, because it's going to be years as all of the loans kind of trickle out.
So that's the really amazing thing, is that it's such a granular building by building thing. It's not like, okay, here's 40 million conforming mortgages and here's the rates on them and they're either 15 or 30 years. Go. It's every building has a different cap table. Every building has a different amount that's financed. Buildings are typically anywhere from 40 to 80% commercial real estate is financed. So if you're a bank and you lent half the value of the building, well, as long as the valuation doesn't drop in half, you're pretty protected. Once that happens, now you have to figure out how big of a haircut are you going to take. Do you just take the building and sell it? Do you take the building and try and work out of it over time? Do you offer a deal to the owner and say, all right, we'll refinance the building at 50% of its previous value? So it really depends. How much does the building owner itself own in terms of equity? How much is leveraged? And is it a Class A building? Is it a super Class A building? You look at some of the buildings at Hudson Yard and Bloomberg. Super A, like One Vanderbilt.
Yeah.
They're fully booked. They're, I don't know, $200, $220 a square foot. The prices are really quite like shocking and fully booked. It's not just the difference between A and B. It's the difference within A and location, near transportation, and there's just so many things. And I think, on the residential side, it takes homeowners who are very emotionally involved in their houses. It's where they raised their kids, where they made all these memories. And when the market goes south on them, it's very difficult for individual single-family homeowners to adjust their price. We saw this in 08, 09. We saw this in 05, 06, that sellers are always 18 to 24 months behind the market. You're kind of seeing something similar in commercial building owners. Landlords, no one wants to say, hey, this building I own that was worth $100 million and had a rent roll of $120 million a year, it's only generating $60 million a year. Let me lower my prices. Nobody wants to do that.
All right. So, I mean, I'm just wondering, I feel like there's got to be some pain for the markets somewhere. Or is it just an individual owner of an individual building? I don't know if I'm going to have a wave of bank earnings that are going to say, oh, my gosh, we're having a problem because of our commercial real estate. I'm not hearing anybody tell me any of this.
I mean, and just look at New York Community Bank, right? Like it was.
Yeah, it came out of nowhere.
A big, but it was just one apartment building.
Yep.
I think there was another issue
Right,
too,
so
but it was just one
I
thing.
would tell you to look across 5 areas, right?
Okay.
So certainly individual owners of buildings, if it's not a Class A or a super Class A, they're probably going to take a haircut with a few exceptions. Private equity has put a ton of money into this because it looked like, oh, look at how much better we do with no additional risk than the 0% treasuries we were getting. So that's number 2. 3, REITs, a lot of REITs. Some REITs have been really selective and avoided things like office space. Some are festooned with it. And then, again, private investments into those buildings, not just the credit side, but the equity side. And then 5th, bank holdings, they really have to look at what's our LTV, what's our loan to value, what's the capacity of the building, what is their vacancy rate like, how much flexibility do they have in pricing, what sort of incentives are the building owners willing to give, and can we restructure this and not take a bath? And again, it's not like, all right, here are the 500 companies in the S&P 500. We know what they are. It's literally door by door, floor by floor, building by building. It's very challenging.
Sounds like fun.
Yeah.
I'm not doing it. Someone's going to do it. Barry, we appreciate you. Thank you so much. Barry Ritholtz, host of Masters in Business, joining us there. He's also founder of Ritholtz Wealth Management.
Later in the show, we're going to speak to somebody who's says, I think the time's to go in now and start buying some of these things.
I mean, there are the guys that were there.
I know.
You talked to distressed debt investors. I mean, some were buying some of the loans that were offloaded from regional banks. Anyway, we want to go now. What are we doing? What a break.
your company news headlines on Bloomberg Radio.
And I'm John Tucker in the Bloomberg News. I'm going to look at some of the company stories we're following today. Meta Platforms releasing new guidelines for small businesses that advertise on Facebook and Instagram. They're aiming to help them get around fees imposed by Apple. Meta advising the companies to buy ads through a web browser rather than on the Facebook or Instagram iOS apps. So this will help them avoid an Apple commission that Meta says takes effect this month. Apple's new policy requires advertisers to make an in-app purchase whenever they pay to boost their social media posts. Apple takes a cut of as much as 30% on the in-app purchases in its iOS software. Viking Cruise, you see these commercials everywhere. Viking Cruise is considering an IPO in the U.S., an offering that could raise $500 million or more. The travel company working with Bank of America, JP Morgan Chase, among others, on the potential listing. IPO may come as soon as the second quarter. A Wall Street distressed debt maven resurfacing to take on his one-time protege at $14 billion credit firm Kennedy Lewis Investment Management. This is John Bryce, the former Kennedy Lewis chair, who left 4 years ago, seeking a 15% stake in the company. Kennedy Lewis was started in 2017 by David Shane, Bryce's one-time protege. And we'll do this again. Kate Winslet called it a mythical place. Tina Fey hoisted a bucket of its Hokies on Saturday Night Live skit. Harry Styles said it's one of his favorite things about Philadelphia. The Wawa convenience store chain, opened by Graham Wood in 1964. They say they're going to expand to 280 new stores over the next decade. And that is your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. We're almost to the end of the week. I'm Alex Steele alongside Paul Sweeney and John Tucker. You're listening to the Bloomberg Intelligence radio show where we cover all the top analysts from our company worldwide. They cover 2,000 companies in 130 industries. Let's get you some world and national news, though, and kick it off here with Michael Barr.
Alex, Paul, John, thank you very much. A judge in New York has ruled that Donald Trump's hush money criminal trial will start on March 25th as planned. It's the first of 4 criminal cases against the former president to go before a jury. Before heading into the Manhattan courtroom this morning, Trump spoke to the media.
This is a terrible time for our country. This is a real dark period for our country.
Trump's lawyers wanted the trial delayed until after the November election. Meanwhile, a team of lawyers for the former president are at a hearing in Georgia today to argue the validity of his 2020 election fraud charges after alleged misconduct from the Fulton County District Attorney, Fani Willis. An investigation is underway in Kansas City after gunshots erupted at the Chiefs Super Bowl victory parade and rally. 1 person was killed, 21 others were injured, including several children. Roughly 800 members of law enforcement were present. Kansas City Mayor Quentin Lucas was asked, how could it have happened?
That's what happens with guns. I won't get in a big debate right now. I think we're still doing an investigation. But, I mean, what you saw happen was why people talk about guns a lot.
3 people are in custody. The head of the House Intelligence Committee, Congressman Mike Turner, says he wants information released about a serious national security threat. Bloomberg's Nancy Lyons has more on the administration's response.
National Security Advisor Jake Sullivan says he plans to meet Thursday with a group of senior members of Congress after that warning from Congressman Turner about an unspecified serious national security threat.
I personally reached out to the Gang of 8. It is highly unusual, in fact, for the National Security Advisor to do that. I did that to set up a meeting. The Senate's not here. The 4 House members have agreed to that meeting.
One person familiar with the matter says it's related to Russia, but would not elaborate. In Washington, Nancy Lyons, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Paul, Alex, John.
Hey, Michael Barr, thank you so much. Alex, let's follow up on a story we just heard from Mr. John Tucker. Viking Cruises considering a U.S. initial public offering that could raise $500 million. You know how I love the cruise business. Viking was founded in 1997 and operates cruises on rivers, lakes, which I didn't know was a thing, and oceans across the globe. The company's operational headquarters is in Switzerland, got about $4.7 billion in debt. I just like me a good cruising IPO. This could be fun.
It could be fun. Let me just give you some random numbers here. So if you go on the Antarctic Explorer, 13 days, minimum, you're looking at about 12 grand, and then airfare, leaving from Buenos Aires.
Okay, I don't do minimum. I need to get
Boom.
the view. Okay, so that's
What does that
they're not
include?
giving them away.
And then the owner's suite.
Yes, that's what we're
40K.
talking. Oh, okay.
40K, and this is for like a person. This is from what I understand.
Well,
This
Molly's-
is this is per person.
Okay. Well, Molly Smith from Bloomberg News covers economics for us. She went on a trip with, I think, her mom and sister or brother or something like that. And
But they went like in a freighter.
did they?
So maybe it wasn't like an owner's suite costing
No, they didn't
one
do the
person
owner's
40K.
suite. I don't know.
This is interesting. I mean,
But
here
this is like high-end stuff.
This
is
is
my point
high-end
of saying
stuff.
that.
Yeah, well, that's my demo. The company is backed by private equity firm TPG and the Canada Pension Plan Investment Board, which together invested about $500 million in additional capital in November of 2020. Boy, that was a good investment after first investing in 2016.
Now, to be fair, if you go to do a little Rhine getaway,
Yep.
it's much more reasonable. It's just 8 days, and it's just about 2,200, and then plus airfare.
All right.
So, if you do the Antarctic thing, forget it. You're financing
Yes,
your house.
that's
but
right.
This feels more reasonable. But I wonder if it also says, just in general, something fun about the IPO market. Like, are we actually opening up? Are we going to get more deals done? It's not just about AI, and that could be a good indicator.
I could sell this deal. I'm telling you right now. Bank of America, JP Morgan, UBS, and Wells Fargo are the banks listed on the deal. I think that could be pretty fun. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, I want to get some more information, Alex, on kind of how the consumer is doing, how the retailers are seeing the consumer. So we're going to check in with Mari Shore. She's a senior equity analyst at Columbia Threadneedle Investments. She's really smart on the retailers here. We're going to check on Chris Cialino. He's got to tell us what's going on with Deere and the U.S. farmer, because that's when you think about Deere, you think about the farmer selling tractors to the
100%.
farmer and stuff like that. So we'll get that breakdown. And then David Kudlas, founder, CEO, and chief investment strategist at Mainstay Capital. He's going to give us his market call. But we're going to kick it off like my schedule says.
No, you're right. There was an updated rundown
There
that
was
was
an
sent
updated
out.
run-
I
okay.
had the old one.
So
Wait a second. You were going to
John
skip
Tucker.
me?
Maybe she
wanted to skip me?
The first one said skip John Tucker.
Yeah.
So, I do what I'm told.
Oh, brother.
But John Tucker, what do you got for us?
Heard. Anyway, the major stock averages, they are mixed right now. After reclaiming the 5,000 mark at the close yesterday, S&P 500 right now 8 points higher. One individual stock that stands out, SoundHound AI up 46%, extending gains. This is from their 13F filing. Who said those filings are boring? That indicates the chip maker NVIDIA holds a stake in it. NVIDIA also advancing after it overtook Alphabet in market value yesterday. Retail sales in the U.S. broadly declining in the month of January, so that indicates consumers taking a bit of a breather after a strong holiday shopping season. Liz Young, investment strategist at SoFi, was asked to sum up her outlook for the markets.
It's interesting. This has been a big economic data week, and obviously we saw the market wobble quite a bit on Tuesday, but then we were over it Wednesday. We look to be somewhat over it today. I don't think yet that there are enough data points in a row to scare investors out of what continues to be this momentum-y late cycle market environment.
Right now, the S&P 500 6 points higher. That's up 0.1%. 5,006 on the index there. The Dow Jones Industrial Average up 169 points. NASDAQ 143 points lower. That's down 0.25%. The 2-year yield, that's come in now 1 basis point lower. That's 456. The 10 also 1 basis point lower right now after the data at 423. Wanted to bring this breaking headline to you. This has to do with Temenos. The shares plunged after Hindenburg Research said it had taken a short position in the, this is a Swiss banking software company. Now we're learning, crossing the Bloomberg, that the trading has suspended until further notice in Temenos. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. We would never skip. John, I'd never skip you. I mean, Alex would throw you under the bus in a heartbeat.
In a second.
Let's be honest.
I have so many tire tracks on my back.
That I'm just one of many at the
It's
end of the day.
Yeah.
Which is such a joke, because I think John Tucker is awesome. But there's that.
I'm waving to one of my fans outside there.
Okay, Paul has also many fans, which is important to know. U.S. retail sales, so that was a surprise. Also after that CPI, right? You get hot CPI, you would think, oh, retail sales, what if that comes in hot? What if PPI comes in hot? And then you get a little bit of a weaker retail sales number. I really do think, though, that if you compare it to the rest of the world, the U.S. just still has that outperforming sense. I mean, some of that data we got in the UK, Japan, it's not good.
No, it's not. And I was talking to an economist earlier today on surveillance, and I think she was based in Singapore, so she has a global view. She's Vanguard, so she's the chief economist of Vanguard, so the complete global view. And I said, is this unusual that we're seeing the U.S., materially stronger than much of Asia, including China and Europe, and not really, she says. It does happen. But I said, I thought with this whole, aren't we all globally connected? But there's enough of the U.S. having, an ocean on each side of you that kind of makes you a little bit self-reliant, I guess.
Well, also, we had more fiscal spend. Cutting checks, put in people's pockets actually seemed to make a difference. I guess I wonder, though, if you're doing the whole where you're going to wind up spending your money as an investor. Is it going to be then in U.S. tech, or do you need to go to value? If you go to value, does value mean Europe? Because typically value tends to mean Europe. But if the growth there is not great, no. Then is it the Russell? Then is it the cyclicals here? That hasn't always played out well. So I think that decision will be quite interesting.
All right, let's get a beat on how the U.S. farmer's doing here. And we could do that through Deere. Deere is a company, obviously, we all know and love. And their customers, by and large, are farmers. And Deere reported some numbers a little bit disappointing here. Chris Ciolino joins us. He covers all the big ag and machinery companies for Bloomberg Intelligence. He's based down in Princeton, New Jersey. Chris, how did Deere do this quarter, and what's their outlook?
The quarter was great, really. Much better than we anticipated. Across the board beats, both top line and margins for most of the businesses. But the outlook was the disappointment of the quarter. They cut net income guidance by about 5%. And that's largely reflective of incremental weakness in the ag business, specifically the large ag business. And there's really two components to that. One, Europe. Deere now plans to underproduce retail demand due to some weakness in Central and Eastern Europe, given the conflict there. So they're going to try to bring down inventories. They're already underproducing in Brazil as well. And then the second component of the cut was really some additional softness beginning to transpire here in North America. We saw some of the order velocity start to moderate. So demand seems to kind of be trending toward the low end of their down 10 to 15% industry outlook when it comes to large ag equipment.
Yeah, let's get through some of these here. Production Precision Ag net sales for their yearly forecast, they're looking down 20%, worse than estimated. Construction and Forestry net sales down 5 to 10%. Small Ag and Turf net sales down 10 to 15%. Yicky. Is this a early cycle, mid cycle, or late cycle read on the economy?
I mean, we're early in an ag downturn. Last year was a peak production levels. Historically, you don't have 1 year downturn. So I would suspect this is kind of the beginning of a multi-year downturn. And some of the numbers that you're seeing that you referenced on their guidance are well below, market retail demand expectations, suggesting that, they have some more work to do on bringing down inventory levels to more manageable levels, with really the goal of setting up production for 25 in line with retail demand.
All right, so if John Tucker goes on to a lot to get maybe a backhoe for his estate in the Jersey Shore, he can get one, right? There's plenty there on the lot. Can he get a deal?
there's no shortage of tractors and equipment on the lot. You could get new, you could get used, kind of take your pick. Values continue to kind of come down here over the last 12 months, and I suspect you'll see further pressure on the used side. New equipment pricing, Deere's kind of guiding to 1.5%, which is kind of below historical averages. And remember, we're coming off of 3 years of really strong, phenomenal pricing. So returning to I would say a below normal historical trend, which will also be a drag on margins.
Caterpillar had a different kind of read, and I appreciate they also do metals and mining and stuff. So is it going to be the diversified players that are going to really win on this?
Yeah, so construction's holding up certainly better than the farmer and then the ag economy. A couple different moving pieces there. I mean, you still have a tremendous amount of infrastructure-related funds and government stimulus coming through the system that will not only be kind of a tailwind here in 24, but even 25 and 26. So I think that certainly helps offset some of the cyclical headwinds facing both the resi or non-residential markets. But if you look at the farm economy, almost kind of a completely different story. You look at crop prices, which are ultimately the biggest driver of farm income and equipment purchases. Corn, soy, wheat down, 25, 35% plus. So that's beginning to trickle through to farm incomes. Farmer incomes are going to be down 26% this year, and I suspect we'll be under further pressure as we exit the year too.
All right, Chris Cialino, thank you so much. We appreciate that. Chris Cialino, he covers all the big ag and construction, all those really cool companies that are industrial America. Again, our good friends at Deere had a good quarter, as Chris said, but their guidance weaker than expected. And I guess with farmer incomes down so much, that makes a lot of sense because if they don't have money in the pocket, they can't go out and buy new tractors and stuff like that. Let's go to kind of a discussion about retail sales, we saw the government numbers come out for the month of January, weaker than expected. I don't know how much of that is seasonal versus, kind of something more substantial, but our next guest does. Mary Shore is Senior Equity Analyst at Columbia Threadneedle Investments, joining us via Zoom from Boston, Mass. So, Mari, what do you make of the retail sales numbers we had today? How concerned should we be?
Yeah, it's a great question. When I look at the pretty significant slowdown that we saw in January, I think it really reflects two things. Number one, unfavorable weather, which is transitory, but also the shift back to the pre-holiday trend. So when I really dig through the data, I see a continuation of three themes that we really discussed throughout last year, which is the consumer is stretched and continues to spend more on services over goods, and within goods on needs over wants. We also continue to see weak demand in categories that were strong during the pandemic, like home and sporting goods and electronics. And then the third theme is e-commerce taking back share from the stores. So I kind of look at this report and say it's really more of the same as to what we saw throughout 2023.
So if we go to the needs over wants and spending on services, when we start to get the retailers reporting, how do we read that dynamic into those retailers?
Yeah, it's a great question. It's really going to vary by category. So I think we're going to see continued growth in categories like food and health and wellness. Health and wellness, I would also include in there some of the active wear brands like a Lululemon, for instance, and some of the athletic footwear brands. And then again, continued weakness in categories like home, electronics, sporting goods, and I would say kind of flattish results in apparel. The problem is that a lot of those latter categories tend to be the higher margin categories. So they are weighing on the top line, but also weighing on margin.
All right, I'm asking on behalf of Alex here. Talk to us about the luxury end of the market. That's where she plays. What are we seeing there?
Yeah, we're still seeing pretty weak results from the luxury players. Really globally speaking, of course, there's things happening in China, but also in North America and Europe. They're talking more about macro pressures. And I think what's happening is that luxury consumers spending more on services like travel, and some of the luxury players that have more exposure to what I would call the aspirational luxury category. So maybe the kind of mid-tier consumers that were stretching to buy some of those higher priced goods, that consumer has really slowed. And so any luxury player with greater exposure to that kind of aspirational luxury part of the category, I think is feeling the pressure more than some of like the true luxury players. Like I would say in Hermes or Chanel, those are the brands that seem to be holding up the best.
Yeah, the Hermes story is just amazing. Okay, just to be clear on myself, I don't do luxury. I only do sales. Okay, I like luxury on sale, but I like the like Outnet, Ukes, that kind of stuff. This means nothing to the guys in the studio right now. But
how many pairs of shoes do you have? Let's start there.
Nice question.
Oh,
Here
no,
we go.
I actually
That
counted
will
this for my
indicate.
old team. I don't think it's as many as you think it is. I think it's like maybe 30.
What?
Wow.
I have 2.
What? Okay. Mari, back me up. 30 is like a very reasonable amount. But I asked this because we only see a lot of sales when you got to get the inventory out the door. Am I going to be a happy consumer or am I going to be a sad consumer this year?
Yeah, again, it really varies by category and brand, but I would say overall, the inventory this year was in a much better place than what we saw last year when demand really first started to slow and all of the companies found themselves sitting on excess goods. I would say as we moved into 2023, the inventory was better controlled. So when you looked at a lot of the companies' results, the gross margin rate was actually stronger than a lot of investors were expecting. Part of that was, lower promotions, lower markdowns than what we saw the prior year. So as we move through the holiday, I would say most of the promotions we saw, I would classify as in line with plan. I don't think we saw super aggressive promotions, and that really reflects the fact that most of the brands and retailers are sitting on pretty lean inventories right now and continue to manage their inventory very conservatively, just given the weak demand backdrop.
This is sad for me.
Exactly. So, Mari, how about down at some of the dollar stores, for example? I'm not sure how that really works out. Do they benefit when times get a little tough because maybe people trade down to the dollar stores, or do their typical customers, do they feel it more acutely? How do they play these days?
Yeah, it's a great question. Typically, you see both happening simultaneously, right? So you would see their core customer come under pressure, but that be offset by the more kind of middle-income consumer trading down into those discount formats, whether it be dollar stores or even some of the off-pricers like Burlington and Ross that cater to a lower-income consumer. I think this cycle, we saw kind of a delayed trade down from the middle-income consumer. But as we kind of move through Q4 and into this year, I think that should be more pronounced and really help some of those discount formats. I also think what's happening with the dollar stores is you've seen Walmart, I think, take a lot of share, right? You can see it in their results when you compare Walmart to, the Family Dollar business, which is owned by Dollar Tree and Dollar General. So I think you have a lot of things happening at the same time, but overall, a weaker macro backdrop should be a positive for those discount formats.
Also, it's weird. It's like dollar stores are no longer really dollar stores. Like they're like $5 stores, and their inventory is like horrific. I mean, in some of them, we have a house. Sorry, go ahead.
Oh no, go ahead.
I was gonna say, like, going in one, you're like, this is like scraping bottom of the barrel of inventory. Like it is not a pretty shelf site.
Yeah, I think a lot of the dollar stores have kind of struggled with the store standards and the service levels to that point. And both Dollar Tree and Dollar General have talked about investing in better inventory management systems, more labor in the stores to help improve the store shopping experience.
All right, Mari, thanks so much for joining us. Mari Shore, Senior Equity Analyst at Columbia Threadneedle Investments, joining us via Zoom from Boston, Massachusetts. Threadneedle, originally a London-based, UK-based investment firm, and now it's Columbia Threadneedle because they were acquired by Columbia.
Yeah, they have great analysts.
They do. They're very good.
Some of the best.
Yeah.
Not, Bloomberg Intelligence and
very good. All good.
Let's put it there.
All good. Yeah, but good read on the retailers here. So I always like paying attention to the retailers, whether it's the Walmarts or, the luxury, just get a great view of kind of how the consumer's really hanging in there. And generally has been hanging in there. For the luxury, I'm waiting for them to say, China's back, baby. They're buying mainland, they're traveling, and we haven't heard that.
I don't know if it's going to happen, to be honest. If it hasn't happened at this time, it's really hard to make that case. Plus, even if they say that, will investors be that willing to buy that narrative when they got burned in the first quarter of last year from that?
Yeah, part of that was the Chinese traveler, they couldn't fly anywhere, but now it's getting a little bit better, so maybe that'll help. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Investors are chewing today on some surprisingly weak retail sales figures. Major stock averages, they are mixed after closing around 5,000 yesterday. The S&P 500 is up just 5 points, 0.1%. We're at 5,005 right now. NVIDIA retreating from an all-time high. Cisco Systems sinking on plans to cut thousands of jobs. They had a slowdown in corporate tech spending, wiping out the sales growth there. Right now, the Dow Jones Industrial Average up 151 points. That's a rise of 0.4%. The Nasdaq 100 down 52 points, a decline of 0.3%. The outperformer, the Russell 2000, 1% higher right now. And as we look at Treasury yields, they were lower earlier. Right now, the 2-year has become unchanged, 4.57. The 10-year still lower, down just 1 basis point. That is at 4.24. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're also streaming on YouTube, so you can head over to youtube.com, search Bloomberg Radio. We're also in that Apple CarPlay, the Android Auto as well, so you can check us out there. Let's get a sense of where we're going with this market, because I don't know whether it's time to jump off the big cap tech train that's worked so well for so long and maybe take a look at some of the smaller mid caps, maybe some value. You don't know where to go here. David Kudla's got some thoughts here because he does this stuff for a living. He's a founder, chief executive officer, and chief investment officer at Mainstay Capital Management, joining us via Zoom from Troy, Michigan. It's a lovely town. I've been there once. David, what say you here? I mean, for a lot of investors, that Magnificent Seven has worked so well for so many people. Do you just stay with with that horse, or do you try to maybe look for some value in small cap, mid cap, maybe some of the sectors that have lagged?
Yeah, and good morning, Paul. When we look across the market, and we know that the Magnificent Seven had a great year last year, up about 110%, and we now have a Fab Five that excludes Tesla and Apple that's doing very well this year. And, the concern is, can we see a sell-off? NVIDIA, with this meteoric rise, can we see a sell-off in these stocks? Of course we can. It wouldn't be surprised if 5 or 10% or even more at any given time, given the rally that we've had and the Magnificent Seven this year and the Fab Five last year. But, our overall thesis, we like growth over value, and mega cap tech and profitable tech is our most favored sector last year and coming into this year. And we look forward, we look over the next 3 years at the annual growth rate of the Magnificent Seven. It's 4 times that of the rest of the S&P 500. If we look at profit margins, they're going to expand at a lot higher rate than the other 493 stocks. You take out Apple and Tesla, those numbers get even bigger. So we're still on growth over value, growth over value, large over small. We had a rally in small at the end of last year in small caps, a little bit here recently, but small caps, the problem that small caps have, if you become a good small cap stock, soon you become a good mid cap. So you could become a good mid cap stock. So the Russell 2000 by definition has that kind of problem. And in the environment we're in with higher rates, it's tough for small caps. And then finally, we like the U.S. over foreign.
So David, to that point, what do you do then? Like, all those trades are working. All those trades have been working. Do you just kind of put the positions on and then sit tight and then wait for all that to play out?
Yeah, well, the approach we're taking is, yes, we are, very dominant in NASDAQ 100, those mega cap growth stocks. We're dominant there. We're diversified in some other areas and need to be. In the income portion of our portfolio, the thing that's worked so well last year and into this year is holding the ultra short-term bonds with high yields. The bond index, U.S. aggregate bond index, was slightly or only slightly up last year. When we look at these ultra short-term bonds with high yield, up 6 or 7%. So if that's the income portion, with this growth dominant portion for equities, that's a formula that's still working for a diversified portfolio.
So, David, I know you prefer U.S. over international markets, but I see you mentioned China here in your notes, and I'm sorry, Japan. And I've heard more about Japan in the last 6 months than I have in the last 20 years. What's going on in Japan from an investment perspective?
Yeah, we've heard more about Japan in the last 6 months than we have in the last 35 years, exactly. Because we're bumping up against that high that was set in December of 1989 when I was walking around the Stanford campus learning about investing, right? I mean, it's that long ago, that giant trough that we're coming into. And Japan has some things going for it. They have still easy monetary policy. They have the capital flows coming from China. China is nearly uninvestable at this point. And then President Trump comes out and says, if he gets elected, I'm going to put a 60% tariff on all Chinese goods. I mean, with everything else that's wrong in China, with Evergrande, their real estate sector, all that, more bad news coming. And, so they've been doing a lot from a stimulus standpoint, but that stock market continues to be, mired in a downdraft. If we look at Europe is near recession, kind of in and out of recession. The UK is in recession, and actually we just found out that Japan unexpectedly got its second quarter of negative growth. But we've just got a easy monetary policy, capital flows there. Valuations are starting to get a little bit lofty, but it's still investable.
What do you make of the BOJ and them getting off of yield curve control? Like, does that factor in to your thinking? Like, clearly there's a carry trade that's going to unwind really fast. Clearly that's going to affect the treasury market. Does that affect you, David?
It affects us in that we're watching what the yen is doing, because the yen, it just continues to weaken, and they've come in, they've intervened. The BOJ has intervened several times, but when they do, those tend to be temporary fixes. Those tend to be just temporary in nature. And our concern there, really our concern now, is with the economy in a more fragile state. What will they do in April? Will they finally raise rates? I mean, what they've continued to do while the U.S. went through their massive, 525 basis point increase in rates from zero, Europe raising rates. We have Japan there that's just maintained this easy monetary policy. They've made some adjustments, but they've got a weak currency that continues to weaken, easy monetary policy. And, we'll see. But the moves that they've made have been just minor, almost non-events in terms of if they really started to tighten monetary policy, which they haven't.
So, David, we're about 75% of the way through the S&P 500 earnings. Any themes for you? Any takeaways for you? Any changes to your portfolio based upon what you're seeing?
No, I mean, we're beating expectations again. Earnings coming out better than expected. We're beyond that earnings recession we had last year, and now seeing earnings doing quite well. So, I mean, we're encouraged by that because that's what we want to see with the Fed. Well, we're still concerned about the Fed, obviously, but no, it's really supporting where we're at in terms of growth versus value. I think, as we get into the second half of the year, we think we have some volatility here for a few more months. We get in the second half of the year and we start to see the rate cuts come. If that's June, let's say, that they start, and remember that just weeks ago we were looking at March for rate cuts to start. If rate cuts do start that soon, and I think it could maybe even be longer, then we can come in. Then we can feel more comfortable about dipping into small cap, dipping into cyclicals. But right now, I mean, we're encouraged by earnings, and it's supporting the areas that we like.
Right. All right. David, if I find myself in Troy, Michigan this summer, would you recommend I pay a visit to the Waterford Oaks Wave Pool?
Oh, I love wave pools, even though they're creepy and weird.
I think you should, and if you do, give me a call and we'll go down there and have some fun. That sounds like a lot of fun.
I've been to Troy. I did one of my internal audit visits when I was at Payne Weber to the Troy, Michigan Payne Weber branch. Had a good time there for a week. Good folks out there. David Kudla, thanks so much for joining us. David Kudla, founder, Chief Executive Officer, and Chief Investment Strategist at Mainstay Capital Management. All right, there are two kinds of people out there, Alex. Yep. Beach people and lake people. What are you?
Definitely a beach person, but in general, I'm not a water person.
You're generally not a water person.
No, I'm scared of fish, and lakes are gross.
John, the things we're learning about Alex,
doesn't
Alex Steele over the last few weeks just never stops.
Just bring one of your 500 shoes and smack them on the nose if they come near you.
Number one, it's 30. Number two, those can't get wet.
It's
Come
funny.
on now.
Oh, okay.
You?
Totally.